I get ahead, I end up going 2 steps back. So tonight, I'm just gonna let this one ride. You know what I mean?
Welcome back to TradeDelicious Live. It's morning briefing. It's 8:30 a.m. Let's get into a little bit of morning briefing. This is a show where both John and I, we're going to debate different positions. We're going to talk about some of the fundamentals, and we're going to get you up to scratch with everything that you need to know. It is 18th of June. It's just gone 8:30 a.m. British Standard Time. One day we'll get in here when it just is 8:30 a.m. British Standard Time. But I hope you're all having a fantastic day. John, good morning to you. How's the weather? Have you looked outside today?
Yeah, I've actually been outside today, which is good. Yeah, so I went to the gym nice and early. I'll say nice and early. I was still trying to write a report as well last minute. I was just like typing a few little bits up, and then I was like, oh crap, I said I'd be at the gym, so I got the gym gear on, went out.
Discipline.
Discipline
right there.
Yeah,
first hand.
And it's lovely, bright sunshine today, blue skies, stunning. Yesterday was horrific. Yesterday I actually nearly took a picture for you yesterday and said, "Do you believe it's the British summer here?" But I didn't want to embarrass the UK. But how are you anyway, mate?
Yeah, no, I'm well. It's been nice weather today. We're in the middle of winter, but we seem to be pretty consistent with a nice blue sky morning into a bit of rain in the Arvos, which I don't mind. And starting late today because I'm going to be joining the Fivers stream a little bit later tonight. So we've got our stream that's going to take us right the way up pretty much to the Fivers stream. I'm going to head over there and talk macro with Alex and the masked trader, his name is. So I'm pretty excited for that. But
okay.
Went out and did some fishing this morning. Managed to get the morning off, and it was a nice blue sky, so I didn't catch anything, unfortunately. A bucket ton of seaweed, but no, I didn't catch much. The coast, pretty strong currents, so it was just picking up my weight. My weight wasn't strong enough; it was picking it. Are you a fisherman, John? Do you like fishing?
I've never really done any fishing apart from crabbing in the UK, which is just you get a little hook, get a few crabs. Common. I enjoy doing that. Yeah. But other than that, I've never really been fishing. My dad used to go like sea fishing, but he never took me with him because obviously it must have been a bit of a jolly for him. He used to come back very half soaked, so or full soaked. Yeah, he never took me with him to do that kind of stuff. So, but no, I never really got. I'm more of a golfer, to be honest. That's my bag.
Let's do both. But no, I agree. Look, I'm not a huge fisherman, but since moving this close to the coast, I like fish. I like the different types of fish and actually eating it. So I catch catch to cook, and I think it's beautiful. I really enjoyed it. There's something recently golf. I think I'm getting old. I think I might just be getting old. I think I've just had that realization as I'm explaining this.
Literally,
my interests are golf, fishing, and drinking beer. I think I've just had a midlife moment.
maybe.
Help.
I would possibly agree with that.
But there's something, life is so chaotic when you're a trader. Macroeconomics, doom and gloom, reading news, trading, like high performance. It's so grueling on your mind that I'm really, really, I used to be big into gaming. That just stresses me out now. It stresses me out.
Oh, really?
I prefer doing something like that, getting out and just switching the mind. Or I can be out there. I used to not enjoy fishing, boring. I'll sit there with a fishing rod, wait, are you joking? And now I could be out there for 5 hours, not catch a thing, and still be like, that was a day well spent. There's just something peaceful.
You're outside.
Yeah,
peace. Yeah, outside in the peace. Yeah, I must admit, like, I prefer trying to get out as much as I can. Sometimes when my partner comes home from work, like because we're quite isolated as traders, I'm straight and going, "Oh, how's your day?" And she's just like, "I need to debrief. I need to just chill for a minute before I start talking." But I like to just get out, go for a walk every now and again, just to kind of get that. Like that's why I love golf. To be fair, like 4 hours of just doing nothing. There's nothing on your mind apart from hitting that, trying to not shank the golf ball. That's that's the reason why I love it the most. I think it's good as well. Good to get a little break from the markets. It can be, like you said, especially macro stuff. Everything that grabs the attention on macro is just doom and gloom, isn't it? Everything that gets the people talking, gets people chatting about macro is there's a crash coming, this has happened, X, Y, and Z.
World's over, there's a new war.
Yeah, and it can be draining. It can be draining. Macro is fun when you make money from it, but it can be draining when you're just looking at macro a lot and you're listening to reports and it's all like the world is ending. I actually saw a report yesterday, which was quite refreshing. It was like because of the French elections coming up, and obviously we've seen the downside in the French stock market, which is obviously the second largest sort of economy in Europe. They were actually talking about buying the dip, which I was like, oh, that's
you mean optimism? You read a piece.
And it was really refreshing. And I was like, oh, this is completely. It kind of hit me by surprise. I wasn't expecting it. I was expecting him to go, should you buy the dip? Absolutely not. But it wasn't. It was just a report of like, actually, there could be good reasons to buy the dip. So I thought, what, that's quite interesting. I like that. I prefer that.
Is that what we need to do? We need to come in morning briefing and at least once a day bring a optimistic look. Something in that says, hey, this is good news. One spot I definitely can't do that today is the Aussie dollar. We'll touch on that in a little bit. Yesterday, during the live trading floor, we started getting on the topic of market manipulation. Rich and David were talking about market manipulation and what it is, how it works. And I put something in the chat. Can anyone in chat remember what it was that I was talking about? I'm interested. I'm going to go through the quote of the day and I'm going to get the weather report from Paul as well. But in the meantime, if anyone can remember what it was we were talking about in chat that I said I was going to do a very small piece on this morning, I am still going to do that and touch on that in a moment. But I want to see if anyone can remember. In the meantime, quote of the day. You ready for it?
Ready. Go for it.
This is coming from Dr. Alexander Elder. And before we get into it, Muscle starts it off with good morning, one and all. Let's make some good trades today on your Muscle. That's awesome. All right, quote of the day from Dr. Alexander Elder is coming in. The goal of a successful trader is to make the best trades. Money is secondary.
I like that.
Do you?
I like that.
I don't like it.
And you don't. Yeah, I think because it's more. There is an art of process over capital in a way, because it can be, especially when you're trying to increase your capital size, it can be quite daunting. I oddly feel better with more capital because I feel like I've got more room for error. and it's a weird thing. When I've got less capital, I feel like there's more pressure.
Yeah,
Whereas if
no, I
there's
agree.
more capital, I actually feel a lot more comfortable. And I think it's people don't think it's the other way around. Maybe think that if you get more capital, oh my God, I've got all this capital now. How am I, I don't want to lose it. That's what the mindset is. But I actually found when I got more capital, I was like, oof, I feel a bit more relaxed.
I don't disagree to a limit. And even I had some of the TradeDelicious team disagree with me. With I've got a number in my head I've never been able to trade above. Right. I was, had the money in the account up to that point, just never been able to perform past that point. And I've never tried since. This was probably
Okay.
2 years ago when I hit that cap. And I've just reduced it and I'm dealing with more money than that number, but
Yeah.
it's in other assets. I'm talking perfect, like primarily my trading account has never been above
Yeah.
that number. But I agree. More money you have, the less risk you have to take percentage wise, the more free you feel. But it depends where that money's come from. If the money's your money, I agree. If the money's someone else's money, I disagree. I take the pressure a little bit more.
Yeah. Oh yeah, absolutely. Absolutely. But yeah, I don't particularly like trading other people's money.
I hate it. I stopped doing it a long time. I've done it and I
Yeah.
hate it.
Yeah. Yeah.
Absolutely hate it. But we'll
When
talk
I
about
first
those horror
start,
stories.
yeah, let's not get into that now. I could talk about that for hours.
Yeah, I've had geez. Yeah.
Yeah.
Let's talk about market manipulation because this is something a lot of people talk about. Because there's an essence, especially among beginner traders, that blame. There's an essence of blame, right? Whenever they have a losing trade, they want to blame it on something. They feel brokers, market movers, whatever it is, they're out to get them. They're stop hunting, that old words. I don't believe much of that is true. I believe there is market manipulation, and we can show what market manipulation is, and part of that is a thing called painting the tape. Have you heard of painting the tape before, John?
I haven't heard of painting the tape. I've heard of spoofing, but I haven't
Spoofing,
heard
yeah.
of I haven't heard of painting the tape.
Okay.
So
Well,
yeah,
good.
I'm intrigued.
This is easy, right? It's a very simple concept, and I wanted to show you an example of this. Very hard to do because it's highly illegal. It's so well hidden that it's hard to like pick a point and say, "Hey, this is where that's actually happened," because no one's doing it that easily, right? On top of that, my trading view is completely gone. So I'm I'm just going to explain what painting the tape is. It is where you and your buddy, for example, John and I, will sit here, and John, I've got 10 million. You've got 10 million. We're going to jump in on an individual stock or maybe the S&P 500, and we are going to buy and sell shares between us, right? I'm going to bid to buy at $1. You're going to bid to sell at $1. We're going to do the same at $2, and we're going to do the same at $3. And between the two of us, we are going to cause a rapid movement in this stock price. We're not going to make any money, right? But we're going to do it between us. We're just going to be buying and selling, buying and selling, buying and selling, right? At each time, we're going to flip the drawdown on who the person is that's in the drawdown. Very simple, very doable, very easy, right? This happens, and what happens is this causes a $2, $3, $4, $5, $6, $7 movement in an individual equity or asset very quickly. And what that happens is other investors, whether it be robots, whether it be individual people, assume there is an active catalyst on this stock and they get FOMO and they would rather be exposed to this. If you're seeing a stock move $7 in a matter of minutes, you're assuming there's something big, there's some kind of news. So people want to be exposed to that. So what happens is all of those retail investors start buying in and push it an extra $2 on top, which is where both you and I flatten our positions. So we make that $2 just at the top and we walk away, right? We bid it up $5, wait for everyone else to bid it up $2. We sell everything, we walk away, we want nothing to do with it. This is called painting the tape. It shows on the volume, it shows that there's active buyers and active sellers, but the reality is it's two people with their book just bidding it up to have fun, to get these other investors involved. Highly illegal. Highly illegal. And there's multiple times we've seen this where people have done prison time for it. However, Still happens. And people are sneaky. If you're going to give people an easy way to make $2, $3, $4 million, they're going to find an easy way to make $2, $3, $4 million.
Yep.
So sometimes the reason I'm putting this forward is sometimes we read volume, we read what the price action may be doing, right? Is the price action doing what it's doing because of your theory on the market or because of a macroeconomic event? Or is it doing it because two people want to bid it up? And the truth is, you don't know. You don't know. You don't know. And this reaffirms that we play in a probability game. You never know. A certain candle structure does not mean something. A certain volume print does not mean something. You don't know what's going on. You don't know what's working. We've talked about the fat finger press that happened and caused a minor crash in the DAX a few years ago, right? And the fines that they've gotten for it. You don't know what's causing this movement, and that's okay. I'm not expecting anyone to know. That doesn't mean you can't make money, but it means that everything is probability. And if anything, it should scare the out of you because it means your risk management needs to be in check because you never know what's going to happen. And that's why I wanted to share that today.
Yeah, no, absolutely. Absolutely. I didn't know it was essentially, I mean, it kind of makes sense in a way because it's, yeah, like you said, it's, if you see that price kind of rallying up, you do get that kind of, you get that anxiety, don't you? And then they see the extra volume coming into the market and they take the other side of it. So yeah, I can see how that is highly illegal as well. Yeah. But I only knew sort of spoofing, like I said to you before, like I used to when I was trading Euro futures and I was looking at the ladder, you could see the transactions going through and you could see completed transactions and even sort of uncompleted transactions, just orders waiting to be filled at certain prices. And you would often see a very large number coming into the futures price,
the book.
and you would price trying, you'd see price trying to head for it. So yeah, that's why I guess that's why I like volume so much though. I like volume because I feel like it's a magnet for price, and I feel like it's where decisions have been made. So that's why I really like trading with volume, to be honest. I must admit, if I could go back to level 2 data, I probably will. So I probably will get back to level 2 data at some point. But right now I'm sticking to the swing trading.
I'm very much in the same boat. I use the volume profile in my day trading. Right, it's arguably my most important tool in my day trading, which is showing me the price that volume's been traded at. Now, whether it be tick or whether it be real volume, yes, there's discrepancies, but as a kind of average, it seems to work here and there. So yeah, I agree. But it's important to know spoofing orders is a very popular thing. Still happens because it's not illegal. It's not illegal to put in an order and then pull that order before it gets filled. That's not illegal. No. So spoofing orders happens all the time, and you see it on the book. A $4 million order to buy Tesla at $200 a share or something will come in, and you will see people bid that price up to that to fill that volume. And then before it gets there, it's pulled. It's gone. And it's like, hang on, that order just never a thing. How is this? It's just moved the market. That still happens every day.
That's crazy, really. That shouldn't be right, really. I don't think either.
But how do you stop that? Like, you can't tell people, hey, you can't put this order in unless you fill it like that. That's just.
But there's got to be someone behind the scenes going, right, we're going to put a big 4 mil order here. You do what you do.
Yeah. You do what you want to do with this information. We're going to put a big order here.
We're going to put a big order in, I feel like it's a bit of manipulation in itself as well. I mean, there's a lot of manipulation in the sense, I know a lot of people talk about sort of liquidity grabs and things like that. I don't know what your thoughts on things like that. What are your thoughts on liquidity grabs? Do you think that's a thing, or?
I think they're a fancy way of other people saying stop loss hunting. Supply and demand concept, right? You're looking for an area where a lot of people are going to have stops. Most of the time, it's based on where retail people have their stops. I'm going to go 80% of retail traders across the globe are trading CFDs, so there's no real market orders there anyway. So no, I like to take the controversial approach and say, It's just another, like, you got to believe in your strategy and you got to believe in your system on why it works, right? And yet you have to believe in the system to make money and to do it consistently. And I think that's one way a lot of people like to believe in their system. There's a lot of stuff out there, whether it's supply and demand, support, resistance, Fibonacci's, you can go into anything, right? The smart money concepts that keep being brought up, I think they're a load of shit. Just my approach, right? I'm just doing it, but that's but I like that about TradeDelicious as well, as we can challenge this. That might upset ruffle a couple of feathers. Defend it. You know, like that's kind of what TradeDelicious is about. It's all about having these conversations. Well, why? And it's called smart money concepts. I mean, come on.
I know it's a thing. I am of the same opinion. It's almost like it's an added layer of supply and demand. It's like
it's just changed the wording.
The word, and the word fair value gap now really. No offense to anybody that tries it. It really, like, I get like a shiver when I hear it.
A few members of the TradeDelicious team use it, right? And they make money. They make money.
Well, then fair enough.
That's part of their system. And I go, that's fair, but I still think it's a load of jargon.
Like, I do think that, I do think that's just, I'm not gonna, I don't want to go into details.
This is a conversation.
No, but like, there's a million ways to do it, isn't there? Like, I saw a thing today. I don't know if you've seen it. There's a Bloomberg strategy that has 100% win rate so far this year, and it's based off a technical indicator. It's not based off any fundamentals or anything like that. And it's just basically based off of the moving average envelope indicator? I don't know if you've heard of that one. And that's what it's based off. But
I've used moving average ribbons, but the envelope is very similar to a Bollinger Band.
Bollinger Band, yes.
Yeah.
And that's got 100% win rate this year. So you think, when you hear things like that, you think, well, there are a million ways to do this.
Yeah.
And I'm very open-minded, but sometimes when I see things, I go, I don't think that is the wording for it really. I just see it as there's a low volume zone. There's like which can be a ledge of volume that's blocked. Price is just blocked at that point. You're just not going through that point.
Yeah, well, everyone's got their own perception, and that's the beauty in trading. If there was one way to do trading, we wouldn't have a market. It's where buyers and sellers need to outbid each other, right? It's so we need that discrepancy. We might be wrong. We might look just like absolute mugs. They might be onto everything, right? But it's just, and that's the beauty. You've upset Stephen because he's spamming FVG, 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 FVG.
I'm so sorry. I'm so sorry.
But that's and this is the thing. If you trade this stuff, right? Sasquatch has come in with same as market imbalance, FEG, whatever. If you trade this stuff, that's fine. Like, we're not saying you shouldn't, right? Because there's no right way to do it. But if we say this and it upsets you, then there's a problem, right? Because I want you to come back and say, Jordan, your strategy is full of BS, and challenge it, all right? Because you might be right. You might see something I don't see. And I look back and be like, hang on. Actually, maybe I have been doing something a little bit wrong. Like that, maybe I should adjust, and vice versa. When we say that, maybe we're just saying it to try and help. I've been in the market for a little while now. Fair value gaps, liquidity grabs. Guess what? 5 years ago, they were called support and resistance. 5 years before that, it was called supply and demand. It's just been replastered and put out in a fancy way in marketing. So it's just, I just like to throw it out a little bit. I just like to be a little bit controversial. If it gets your brain ticking, awesome. That's what I want it to do. If it upsets you, it's not what I want to achieve, but I want you to ask, why is it upsetting you? Nevertheless, we've just spoke for 23 minutes about market manipulation and what we think. Let's do this rapid then. Let's talk macroeconomics. You got 8 minutes of macroeconomics here real quick. First and foremost, RBA surprisingly come in, didn't change the interest rates. We all knew it was happen. We felt it was going to happen. They've come out with a very uneasy tone going, oh boy, we've got a bit of a problem. I read the statement, so you don't have to. RBA is not happy. We're seeing growth in expenditure, and we're seeing growth in net worth of the population of people who own homes, because we've seen incredible growth of the housing market, but then they're looking at the labor market and it's not good. The GDP is not good. We've spoken about this. They finally addressed the GDP per capita in their statement. Hip, hip, bloody hooray. Finally, they're turning their eyes to actually something that's going to work. And now they've come out and they've said, until we see an increase of production growth in Australia, they do not believe the inflation will come down. So they've hinted that production growth, which you can find through GDP, you can find that data through GDP, is their number one key metric in whether they think inflation is going to fall, which is obviously their metric for whether or not they're going to drop or hike interest rates. So next GDP for Australia, get ready for some volatile movement and keep an eye on that production growth, because that's where the RBA is looking as their incentive on which way the interest rates are going to go. John, I'm going to send you over to US dollar, Japanese yen. Quick rapid fire. What are we looking at?
Yeah, so I'm just looking at this. It's actually nothing to do with macro right now. It's all to do with actual little pattern here. Well, I guess there's a little bit of macro in it. Obviously, the Awade is actually speaking at the moment at the Japanese Parliament, and it might have been yesterday and today, basically discussing their future monetary policy, talking about the bond tapering situation. They're seeing increases in wages, which, you know, again, they're on the roll now, I think, of potentially coming to a point where they're going to have to take some action. They're just going to do it very, very slowly. So I feel like there is possibilities of still seeing dollar yen move higher. And I noticed this little trading pattern here. This is probably one of, and this is probably a silly thing to discuss after we've been discussing fair value gaps and things like that. But I find this pattern is a very good pattern to look for. And the reason being is because you've got a clear level of resistance. There's a clear level where sellers have re-entered the market here and here. But what you notice about these movements is the movements away from the zone of resistance are not strong. They're very, very lackluster. You've got that kind of initial burst of I would say volume of selling pressure coming in, and then you've got this very, very slow move back up, but then you've got a very, very slow push away from this area, and that tells you a lot. We talk about candlesticks and how candlesticks, not a specific one, really gives you enough information. But I find if you have a very good slowdown and a very, you know, like a consolidation within price, that can tell you a lot about the market. And here we've had that slowdown, and now a pattern like this is very, very popular. It's very easy to spot. If you just look for that area of resistance, and if you see that the lows are getting higher into that point, I find there's a very good chance of a breakout. Same on the downside of things. If you get that sort of bottoming base and you get the highs getting lower, there's a good chance of a little bit of a breakout. So I've actually got some skin in the game on this. I am in at 157.98, which is just around here. So I'm in a little bit of profit right now. I'm looking for moves up into that 159 handle here. Obviously, we're getting to a very crucial point on dollar yen right now, which is that sort of intervention-y type of area around that 160. So I've got a feeling that we might try and push the envelope a little bit here. My currency strength meter that I look at every Sunday that I build was looking at yen weakness again going into this week. Although this is where macro and technicals can get a little bit cross. Macro, I did like the idea of the yen strengthening, but after the recent meeting where they didn't take action, I was like, they're not going to take action anytime soon now. I've got to try and maybe flip that bias a little bit. You did, yeah, I know, yeah.
Bank of Japan we're talking about here, John.
Yeah, Bank of Japan, yeah, you did warn me. And you know that the market's continued up. So you've got to be liquid in yourself, haven't you? You've got to be able to change that mindset. Yeah. And so I'm long right now, dollar yen.
I like it. Skin in the game. That's what we like. We talk about macro. It's only useful if we talk about it if we've got skin in the game. No, I like it. I like your entry point. Don't like the idea of shorting the Japanese yen. I know Bank of Japan come out and said, hey, we're going to sit back, you know, the data, but I also know what the Bank of Japan are like. You're pushing up to those 159s, pushing up to those 160s. What's your target on this?
I'd say 159, maybe even below. I might be at 158, sort of 80s. I might just try and I don't really want to push the envelope here and go for those sort of intervention levels because I don't want to get caught out.
Yeah, fair enough. Fair enough. No, I don't hate it. I don't hate it. I'll give you that. I don't like it, but I don't hate it.
Thanks.
Yeah, like just in
that's
case
my sentiment indicator for today. That is. Does Jordan like it or hate it? That's what I got to go off. It's neutral. You're neutral.
I'm neutral. Yeah, I'm gonna sit my hands. I'll watch. I like it, but look, last little thing to touch on real quick. You wanted to touch on the Swiss franc.
Yeah, Swiss franc's still strong at the moment as well. This is something we talked about last week with potential shorts in and around the sort of 0.9 handle. Swiss franc raising its 2024 growth forecast. Inflation they're seeing still kind of come down to around 1.4%. But GDP they're expecting to grow. That could just give the Swiss an extra little boost that we're seeing at the moment. Swiss franc very, very strong. Really like Euro Swiss. Downside, to be honest. I actually had an alerts up a little bit higher, 57, 95, 75s, and we haven't quite made it there for that downside move. But I do quite like the downward pressure that we're seeing on Euro Swiss. You know, you'd look at that market and think, oh, I don't really want to be technically you could look at it, that's dropped a long way. I don't want to be a seller of that, but also would you want to be a buyer of that right now? Probably not.
You spoke, you spoke what last week about that risk on, or yesterday about that risk on, risk off, and this was kind of my point of the, you know, are we already in a risk off market? I mean, the Swiss franc's running.
Yeah, potentially. And it's definitely early signs of it, isn't it? I think if you were to see a little bit more risk off, we would see a lot more downward pressure in global stocks as well, which we're not really seeing at the minute.
I'm going to interrupt you just real quick, just to be a rude pain in the ass. But I read a report on the S&P 500, and I actually had a look at this. I'll find it. I'll put it on Twitter. I'll at you on your Twitter at John Talks FX if anyone's interested, or at TradeD_TV. You can follow TradeDelicious there. I'll chuck it on. The S&P 500, it was shown obviously how it's weighted at the moment, the Magnificent Seven and those top performing companies. It's only like the top 10 companies which are actually performing well this year, or it's the top 17, I think it is, that have actually printed positive. The other 487 are down, yet the S&P 500 is so high. So when I'm looking at things like that, I'm like, oh, it's literally just 10 companies are the only reason why the S&P 500 is green right now.
Yeah, and isn't 35% of the move down to sort of Nvidia on its own?
Yeah.
So I think I think if obviously, that's where the cracks are going to come, isn't it? You know, the cracks are going to come if the larger cap stocks are going to see some downward pressure. That's going to be where it's going to see some real pain. But at the moment, they're just dragging everything with it. You know, they're dragging everything with it. There's no sign of slowdown right now. I guess if the hype around Nvidia continues and the the performance of Nvidia continues, then who knows? You could drag it a little bit further.
Yeah, scary things to be exposed to. Guys, that's another day. Sorry, we just talked about market manipulation all day, but I wanted to share that with you. And I knew you took interest yesterday. John, we'll see you back at 8:30 a.m. tomorrow. In the meantime, we're going to send you over to Rich. And if he wants me, I might even join him for a little cheeky bit of trading. But we'll see. We'll see if you want me on the other side, Rich. John, take care. I'll chat to you very soon. And everyone else, we'll see you tomorrow.
Cheers, guys.
We're going to make some money today. I'm going to try and make some money today.
I've gone through the top-down analysis. All these levels that I drew in, these straight, we are trading right within value. Would make you feel much better.
We're at resistance, but they're forecasting a little bit of an upside.
It's been a monster move, so don't worry, Rich. I took it for you. It's going to be a little bit more aggressive
than how I go about the analysis. We're going to make some money today. I'm going to try and make some money today.
I've gone through the top-down analysis. All these levels that I drew in, these straight, we are trading right within value. Would make you feel much better.
We're at resistance, but they're forecasting a little bit of an upside.
It's been a monster move, so don't worry, Rich. I took it for you. It's going to be a little bit more aggressive
than how I go about the analysis. Good morning. Good morning, Rich.
Hey, good morning. This is a pleasant surprise. Don't often get to speak to the boss. How you doing?
I'm well. Sorry, I thought I'd pop in. I want to be there for your top-down analysis, Rich. I'm waiting for it. I've been sitting here, I've got 7 lots ready to pull the trigger on whatever you're going to do a top-down analysis on, and I have full faith in what that's going to be. So I'm just sitting and waiting.
Well, we better be quick because I've already got 5 lots riding in the market. Let's have a look. Top-down analysis. So we'll start on EU. I've already pulled the trigger on GU, but let's start with EU. And I'll get this chart up on the screen in a sec. You give me just 1 sec. Who we got in chat this morning? Give us a wave or a shout if you're joining us in chat. We're going to do a top-down analysis. We're going to do a little bit of trading in the markets, live market conditions, and then we're going to go into. Well, I'm not going to spill the beans on that. I'll go into that in a minute. So Euro USD. I'll do this quickly because we're going to be looking at the pound. That's the position I'm already in. So top-down analysis to me starts on the 4 hours. So we're looking at what the market's doing right now. Now. Market is just driving lower all the way down. I want to see a break of this level. If we can get above this level, and we're getting close to it, I'm going to say maybe we've got a little bit more than just profit taking. So at the moment, the market is just moving lower on the euro against the dollar on the 4 hour. Jump down to the 1 hour. This is going to be a speed run this morning. What have we got on the 1 hour? We've already broken. We come down, pulled back to this level here, which is, what's that? 0706. We've legged lower, taken this low, and this is where the market has decided to drive from. We've come all the way up. We've broken this level here. This is an indication that buyers are attempting to move the markets higher. So if I wanted to formulate a trade idea, this would be where I would draw my fib from this low all the way up to this high, and I can go ahead and put one of these beautiful boxes on the 50. Now, this would be an interesting zone for me to buy from if the market was to come back. Let's see if we can remove some of these. There we go. So this is the high of the session today. This is the low of the session. Now, it makes sense in my mind if the market would drive back into this buying pressure before finding a move to the continuation to the upside. So that's what I'm going to be looking for on Euro USD this morning. I've already found the same on GBP USD. So let's jump straight into it.
Before you do, I'm going to interrupt you. Because I'm just going to bring another man in. Welcome, Alex. All right, carry on, Rich.
Good morning, Alex. Sorry, you're literally just catching us on back there. How you doing?
I thought you were going to tell me too, but I told you, Rich, tell me before we're going live. And you were like 20 minutes, 25 minutes. And I just saw the message a little bit too late. So I was like, oh God, I'm so late. And then I jumped in. You're already
live. Man, that's my bad. But you're just in time to hop in this GU long. This is a premium analysis.
Oh, you're going GU long, huh?
I think so. It's the same kind of analysis as EU this morning. So on the 4 hour, what do we got? Market's just selling lower. Now, we haven't broken structure on the 4 hour, not the way that I read price. I would want to start breaking up here. So we jump down to the 1 hour. The market is coming all the way lower. Still haven't broken on the 1 hour. 1 hour is at least this price point here. But if we jump down to the 15-minute, we can see that we've started to push lower. This is the session high. So this is the high of the Asia session. This is the low of the Asia session. And this is London price action. It's come down, taking this low. Now, where's it gone? We're going to zoom out ever so slightly. We can see, let's just move this left. We can see this move lower. Now, check out this. We've gone lower. We couldn't push under this price point, and the market has decided to come up and eventually break this 15-minute structure point around about 26.97. It's not only broken this, but it went on to run the 127 and continue to make bullish pressure. So I'm looking at this zone. If we put a fib from this low down here to the high, we're already in that price point that we were looking at on Euro USD. So we can see that we're already coming back to the 50% retrace. We can put a box from here to here. And my job becomes, how can I pick the best possible entry? To try and find a trade idea to the long side. So this is what I'm looking for. Market to come down, run into this price point, and to just do that absolutely to the moon. This is like a Bitcoin play where the market just runs in a straight line. We're talking 127, 128, 130. Maybe I'm a little bit optimistic here, but that's the trade idea. So I've got a 5-lot position here. Stop loss on the low. If the market runs this low right down at the bottom, which is 26.55, it's just going to show me there was not enough buyers in the market. My job's not to move the market. My job's to try and join in on those movements. So you frowned a little bit, Alex, this morning when I said I got a premium long on GU. You were like, Oh dear, Rich is long. And what's going on?
You're muted.
Thank you very much, Geordie boy. No, no, just I think dollar is very, very strong. The last couple of days and also last week it showed a lot of strength, and I think a lot of pairs against the dollar are also looking pretty bad. But at the end of the day, prices come down so much on pound, dollar, and euro, then you're going to have those nice little pushes up of price just to rebalance everything. So definitely all right. I'm actually looking at gold. We did a analysis yesterday on gold in our trading room, and it looks like it's starting to play out. So that's the position that I'm going into, and I think this is probably a position that's going to take a couple of days. Let me have a look. I don't think let's see what news. We haven't got any major news coming up.
Nah, we got red USD news coming in about 5 hours from now. Can't remember what the news event was. I just remember it was
retail sales.
Retail sales.
Retail sales. So I don't think just retail sales is going to do too much at the moment. I think the Fed, they've just made their statement in FOMC. I don't think that's going to do too much. Maybe we'll see a couple of spikes in directions just to grab some liquidity from different places. But oh, my screen's up. There you go. So the idea of what we were doing yesterday, if I just take all these levels off. So gold has got this little bit of a formation that we've got a bit of a range. We had a deviation of the range up here. And now it obviously came back into the range. And now we're seeing this part of price structure that we've had hit at the top of the range, come back down, come to the bottom of the range, and now it's found resistance at the 50%, which is the middle of the range where most of the volume is actually going through. Now, my idea is, since we can't break, we've had two times to try and break the middle of the range. If it would have come up and got to the top of the range, we'd be in a different story. But we've tried to come into the middle of the range. We haven't broke it. We've had two tries. We've also got the EMAs. We've also got fib levels. If I took a fib level from here to here, you've also got the 50 fib. So you've got all of this kind of confluence just building up for gold to come down a little bit as well. You've got this kind of head and shoulder pattern. So the idea is, obviously, originally in the trading room, we said we were going to wait until price obviously breaks down the low. Then we would get the retest of the bottom of the range, and then the continuation down to a level that is the last bit of demand for gold. Decided maybe, take it before it gets to that level instead, so we're looking to take gold down to the bottom of the range, because it does look quite weak, even on the hourly time frame. We've had that push up, we've had another push up, it's broken down, it's had multiple attempts just to try and break this structure, and it's just failed. So those are the trades that we're currently in, and those trades we're going to hold, and the target is to break down into this level here. Euro, again, we had a couple of trades yesterday. We actually took profits on euro super early. That was the whole trade, that small little push up to the 50 EMA. Let's have a look. So we were looking for just a pop up to the 200 EMA on the 15-minute. Got taken out as a little bit of a mistake on my hand. Then we got back in straight away when we saw that the price was going to push back up, and it did. So we're getting back into trading a little bit of FX, because I got my ass handed to me in the crypto market, as you've probably all seen on Bitcoin. So we're gonna wait and see what happens with Bitcoin. This is disgusting price action. The amount of traders I saw yesterday, it got to this level. So many shorts when price was down right at this level, right at the low. So many shorts, brand new shorts were open. And those shorts got absolutely wrecked. price then shot straight back up, took all of those different people out, and then also we saw a lot of longs get bullish just when price broke these highs, and now it's come all the way back down and liquidated everybody again. So Bitcoin is really choppy. It is a savage move. I got caught on this because I had an open position. I got actually caught on that move coming down, and then everybody else got caught obviously on this move. It's one of those markets that look for complete pain in traders, and it will take everybody, and then while everybody is in the most pain and they're closing their positions and they're getting liquidated, then it goes the direction that everybody thought. So it's just one of those it's a little bit like gold, just a little bit more choppy before it actually gets direction. But that is it. That's what I've been looking at for the last couple of days, guys.
Alex, you talk about pain. You talk about we were talking about this on yesterday's stream. A trader was talking about the smart money trader trap, where sort of traders look for a signal. They say, hey, you know what? This is good. I'm going to get in here. And the market says, yeah, I reckon you will. Let me just come and just lend myself into your stop loss just before I make the move. If I pull up my screen, I'll show you. I was playing around with this yesterday, and the market found exactly that. I'll zoom right in on this so you'll be able to see it. I was looking for a long on GU, and the market was sort of pushing up, breaks this high, and I'm like, this is where we go. We get in, we get this beautiful run to the upside. We get 7 pips just around about here, and I'm like, that's it, we're going. And the market comes down and just swings my stop. That one last time takes me out by 1.5 pips, and the market says, yep, that was the move, and off the market goes to the races. This is a difference of a minus $1,000 relative to about a plus $3,000. That's a $4,000 swing on the account. So when we talk about choppy markets, when we look for that sort of, that pain-inducing move into the market for retail traders, it still catches us out. It's a hard thing. But I noticed something when you were talking. You use this secret code word. Now, we spoke about this last time. You go, I want to do a little bit of study into this. And I think there might be a bit more. And today you come on and you said it. You said the words head and shoulder pan. What's this all about? Is Alex doing a little bit of deep dive into head and shoulder pan?
No, definitely not. This is just, they're just easy things just to tell traders what we're looking at. That's it, man. I think that's the basics that everybody does at the starts, is just understanding double bottoms, triple, just equal tops, equal bottoms, and just basic patterns. ICT, if you look at ICT stuff, or you look at SMC, or you look at all of these different concepts, these concepts just have their own language to help people understand what a trader is looking at in the market. At the end of the day, they're very basic things. They're breaks, retests, they're filling in imbalances in the market, they're sitting on a level and buyers are coming in and said, it's all the same stuff. It's just the language used just helps people understand it a little bit better for their concepts. They can sell a lot more. They can sell a lot more courses by making their own language.
There it is. So I've got a question for both of you. What is the language that's most? What would you say the language is that you understand the most when it comes to any trading concept? If we're talking smart money, supply and demand, Fibonacci or Elliott wave, get it out. What's the one narrative that you go, do you know what? That makes the most sense to me, or that's the easiest to understand? Where would a trader start?
I don't know. It depends on the trader, and depends when they got into trading as well. Like when I got into trading, when we saw, liquidity grabs, as people call them, I would call that a failed auction. Prices got up above a level and it's failed to hold above the level because there's no buyers, or there's no buyers in that area. And because there's no buyers, there's been an imbalance of sellers. It's come under that level, and buyers are now underwater, so they've got to close their positions. And then it all depends. I think you're seeing a wave of new traders coming in, and now they've got the language that you see in this SMC ICT stuff, and it doesn't really matter the language. The techniques are roughly the same, but you can always tell when a trader got into trading sometimes by the language and the names of the techniques that they use. Like the times an SFP, a swing failure pattern. You probably know that one, Rich, don't you? Or FTA. It comes from like Tom Dante, and you hear Tom Dante and people say that was for a lot of people that I know, a lot of traders that I know, that was their mentor. Tom Dante and some of the famous traders back then. Timothy Sykes, if you're looking in the stock trading world. I've never listened to his stuff, but those type of people. Now, if you ask a couple of brand new traders who their mentors are, they're the new type of SMC kind of ICT types of traders that you see on Twitter, and they have their own language. So that's it. What about you, Jordan?
You stumped me. I don't. You stumped me, Rich. I don't have an answer. Your question is, where should beginners look? Right? Like what?
Oh, that was the question.
It was kind of a two-part question. Alex, you nailed the first.
My bad. I just going on a rant on something that is just totally not in connection. But there you go.
I think we touched on this very briefly in morning briefing this morning, and both John and I have a very strong point of view on some of these concepts, and it's one that will upset most people in chat. So I won't go in. I'm not gonna go in and go into it, right? But what we really need to understand, and this is what we reiterated, you have to believe in your system, because if you don't believe in your system, you're not going to show up every single morning to execute on it. So while I don't agree that the reasons that they're saying the price moves is because of the reasons that this system is saying, right? I don't agree with it. I agree with the fact that they've got an essence of belief in what it does and how it works, because it means you're going to be determined to come back and execute on it again. And I think you need that. You've got to believe in your system. I don't believe what they're saying is true. However, if they have an edge and it works over time, and I've seen systems that I call complete BS on. I just go, it doesn't have. People make money from it. People make money from it all the time, right? So go for it. I don't think that's really what's happening, but if you can make money from it, who cares? That's what matters. And if you have that belief in it, awesome. Go for it. You need that belief in your system. You got to believe that price will move when you get in there because of said thing. And that's really important, because if you don't believe in your system, you won't come back when it's not performing for you.
If you ever notice where you're getting into a level or getting into a trade, and then somebody says, "Oh, that's like so and so," or you're trading this concept, but you haven't got a clue what they're talking about. And when you're looking at something, you're like, yeah, it's a break and retest off a 50 fib. But they're looking at, wow, it's, rejection from an order block coming off whatever, So again, it's all language just to help people understand what to do when they see something. It's just in a way of pattern recognition, in my opinion.
So hang on, what if we learnt it all? And what if we stacked all the confluences on top of each other?
I think you know it though. Really,
I don't think it would work, because I think you'd find one of the systems contradicts the other.
Do you think?
Yeah.
I don't know. I saw ICT.
You don't think like a
six frameworks.
Yeah, got it. So
I saw ICT created 6 frameworks, and I looked at them and I'm like, they're all the same thing. They're all exactly the same.
Mm-hmm.
I looked at my created screenshots and put them all next to each other. I said, I could frame a trade idea off all 6 of these things, and I could have them stacked together. I was like, in fact, I think I just kind of trade that narrative in general. And does it mean that when all 6 are present, it's more profitable? Nah, definitely.
But remember, this is coming from one man.
True. And also the problem is how, if you've got all of that in your mind, how long is it going to take you to actually execute the trade? Then once you're like trying to figure it out and you've got all of this different information in your head, simple scales. If you've just got one system that you've checked and it work and you're happy with it, that is, as soon as you see it and believe in it, as soon as you see it, you execute. If you've now got so many different things that are clogging your brain up while you're thinking about it, suddenly you don't execute, and then suddenly you maybe change your bias, or suddenly you don't get in and you miss the trade. So Yeah,
No, I don't want that.
Keeping things. No, you don't want that, because then you get into on a worse position because your trade has gone. Maybe not you, Rich, because you're very patient. But I know me. If I've missed the trade and I see it push it, I'm going to take the trade and take off the extra little bit of risk. Put extra risk on it.
Let me use an example. The chart you've got on the screen right now, right? You've dipped below that kind of range, and now you're looking for it to bounce. Okay.
Yep.
Let's say I'm teaching a trader, and I say, hey, when we go below this line, we're going to buy because we think other people are going to buy below this line. Right.
Okay.
That's simply that is what you're doing. Right. That is right. But now if I say, hey, below this line, we're going to call this a liquidity grab. Smart money is going to drive everything in here. So we stop everyone out, and that's going to cause a bull rush, which we're going to be a part of around this area. Right.
Yep.
All of a sudden you're like, oof, sweet. I'm down for this. Now,
the second one scales and sells so much better.
Yeah, I want to buy that course on the second one.
The exact same thing. Right. But the point is, you're going to have more belief in that because there's some kind of science behind it, right? You haven't done the science, but you believe the science behind it. So there's a good chance you'll execute 20 times more on that one than you will with the other one because you believe in it more. You believe the science behind it, or at least it sounds smart to you, so you think it's going to work, right? And that's kind of what a lot of these concepts are. We can sit here and be like, we think people are going to buy here, so we're going to buy here. Reality of everything we do in trading, we think people are going to buy, so we're going to buy. Or I can sit here and give you a load of financial jargon, and you go, "Oh yeah, that makes me sound good."
Yeah, no, I agree, and I'm just playing it through in my mind. I'm like, this is super
saying,
simple.
Jordan,
it's as complex as
when we sell our courses, we've got to just complicate it just a little bit.
Yeah,
I'm going to sell it in two. Yeah, I'm going to sell it in two languages. You're gonna have to learn dot plots to understand what it means when I say. But essentially yes. But you have more belief, right? And if I go to a new beginner and say what I just said there instead of behind the line, you're going to go, this guy knows what he's talking about. Like liquidity grabs and smart money. That makes sense. Smart money. I want to be with smart money. They're going to push this and it's going to create a bull run. Like, oh my God, like crypto bull run. Like, I'm going to get involved in this. This other guy over here is just telling me to buy under this line because he thinks other people might buy under this line. Like, what? But they're the exact same thing.
Wait, hang on. Chat, give us some feedback on this. Do you care about how complex something is, or are you like, I don't care as long as it makes money? Show me if it makes money and I'll just buy the course. Like, what do we think about this? If I looked at this trade and I said exactly what Jordan said, yeah, I can put a fib from this low to this high. Look, we're in this box. Let's just buy. Maybe the market goes bullish from here. Buy my course. It's $1,700. Happy birthday, right? Or if I was to look at this and go, right, let's really dial into this. So this is as far as price could push. This is the low of the session. Now the market's moving, trying to take liquidity. We can drop down to the 5-minute chart. In fact, we're going to do this. Now, if you look at this, this is super, super important. The market is driving lower. It gets as much liquidity as it can. It gets under this low. It pushes up. We see the spreads open, spikes down, takes everyone out of this trade. Finally, the market comes down, finds enough buyers. If we create this narrative, and then I can show you a pit perfect rejection on a 1-minute candle, because I can. I'm not going to, but I can. I can show you exactly where the market drove to on this occasion. And I could upsell everyone on the idea that this is the turning point of the market. You can scalp this with 3 pip stop losses. And I can show you how this 5-lot trade could have been 50 lots. And we'd be up thousands and thousands of dollars right now. The issue is I can't do it reliably. I'll probably be break even with a 3 pip stop loss. I know it because I've gone and studied this concept. The most profitable way for me to trade this, and it is profitable, is just trading a wider range. Do I think the market will turn on exactly this price point? Yes. Do I have the confidence to trade it with a 3 pip stop loss? No. We go back, look at some of these streams. When I crack the market, I get it to the pip sometimes. Other times, market doesn't perform that way. And I'm just curious, like, do we, Misha's saying keep it simple, keep it stupid simple. I think that's the best approach. It's got to resonate with you, and you've got to keep it really, really simple. But we could overcomplicate this and make it sound like something it really isn't, right?
Yeah. Again, we like as humans, we like context. If your wife comes in, Rich, and she goes, do this, and you don't have any idea of why she's telling you to do a certain thing or do a job. No idea. You don't know if it's broken. You don't know anything. You're naturally going to want to understand the reasons why. If anything happens, you want context. And people buy context because they want to understand how things work. If you just say to somebody, okay, there's a level, this is support and resistance, you know, if it breaks and it turns into support, you buy. It's, to be honest, for me, it sounds super easy and just might as well just do it. But some people like more context. That's all it is, I think.
Yeah.
And if you listen to some of these traders, yeah, I can understand. I can understand why you would like
I like macros
fundamentals because it's super interesting because you understand why things are happening. You understand why there is a move happening, and that context helps you be secure in your decision. You know, be confident in your decision.
Yeah.
But again, it depends on the person you're speaking to. Some people, if you give me all of that jargon that they do with now with the smart money trends and stuff, for me, it doesn't work. I don't like it. It's just too much. For somebody else, they like the context, they like understanding it, and it helps them with the trade. So no cookie. There's no one style that fits all. Everybody can trade the way they want.
I guess that's the short answer to your question, Rich, is as long as you believe in the system, that's what matters, right?
There you go.
I've seen Stephen popped in and said, Alex, you haven't met my wife. I would just do it. No questions asked.
Do you know what?
Stephen, smart man.
Fair enough, yeah.
But what about you, Rich?
Do you know what? I love what Noel says. Our bias is to find certainty in the market. So when new concepts come out claiming liquidity sweeps, etc., people want to believe it's going to work. What I believe in the market is just what I've backtested and collected data on. I said, hey, it's worked in the past. Why would it work? If I can understand it logically, I'm just going to create the most simple rules-based system to try and frame that move. There's nothing I do in the market that isn't backed by, in my opinion, logic-based. And I don't trade anything I don't have data on. So if I can go and collect some data and say, hey, this works. The worst thing is when something works and you go, I can't understand why this would work. I really, really cannot confidently trade something like that. I have to be able to say, this makes sense. Liquidity sweeps, whatever. I want to circle back to what you said earlier. You can tell when a trader got into the market by the terminology they use when they're trading.
Yeah, the year they started.
Like, I love that. When we were at the trading event about a year ago, I got to meet both Jordan and Alex, and there was a gentleman there. I didn't catch his name, and he was probably in one of the smartest suits in the room, and he was talking about how his job is to provide capital for companies, and he said, he was dealing in millions.
Yeah.
Adam. Was it? I'm not sure.
Yeah.
I'm not sure. I didn't catch his name. And he was saying that am I right to go into detail on this? I don't want to spill.
Go for it, man. Yeah.
Go for it. He's his own man.
Okay. He was talking about how he wanted to put several million behind a trader. And the trader said that I couldn't take that kind of capital. He said, why not? And the trader said, because I trade small stocks and there's not enough liquidity, and if I try and enter with that kind of size, I'm going to move the market, I'll get slipped. Not move the market typically. And we were having a conversation with Lucian, one of the moderators, and Lucian was saying, what percentage return do you expect from the kind of people that you invest in? So what's the kind of monthly percentage returns? And I'll never forget his answer. He said, it all depends on the country. I was like, what? And you just remind me when you said you can tell when a trader is into trading based on the terminology they use. He gave a perspective I'd never considered, because I said, share with me something from behind the curtain that a retail trader would never know, but you get to see from your vantage point. And he said, it depends where their country, he said, what their culture is. He said, there's certain countries and cultures in the world, he said, that are incredibly risky. He said, and also, it's not a cult. He said it's very trending that certain mentoring styles resonate with that culture more than different ones. He said, so we could have, say, for example, he said, majority of our US traders might be trading, for example, smart money concepts. He said, and they might be taught, hey, making 5% a month is good. And they're all in that framework and mindset of, hey, 5% a month is where I need to be, and I need to be trading smart money concept. That's what my friend does. That's what his friend does. That's what his mentor does. And guess what? They're all from the UK. He said, you take a trader from, and he said, some of our best traders, they're from underdeveloped countries. He said they are naturally very, very aggressive in their risk tolerance. He said, but they wouldn't trade, for example, smart money concept. And I said, what's the lowest performing region in the world? And he said, well, he said, not lowest performing. He said, but one of the most risk adverse, he said, would be Europe. He said, Europeans are looking just to manage risk a lot more tighter. He said, typically their gains will be lower. And then I asked the bombshell and I said, right, now you've told me what they make as a percentage. What is your drawdown like? What is your maximum risk tolerance against a trader? He said, well, first of all, we pool traders. He said, so we might be looking at 100 traders and putting them in a pot and building a portfolio based on the entirety of those traders. He said, we don't, not really interested. Yeah. Is it not really interested in putting like 100 million behind just one particular market entry criteria? I said, okay. I said, so that pool of traders, let's say they average 5% a month, 4% is 50% return a year. He said, okay. I said, what's your tolerance and acceptable drawdown allowance on that? I was like, because it doesn't matter if you say you make 100% a month, how much are you willing to let that trader lose? Give me your best guess. What do you got? Chat, what do you think? What do you think this sort of professional vantage point was willing?
6% or even less, probably about 4% probably.
I'm gonna take the opposite. I think he's gonna go more aggressive. If they're pooling 100 traders, that means, you know, if let's say they have 100 traders and they put all of their money into there, that means if one trader were to lose everything, they'd lose 1%. So I would say actually, and I'm taking a wild swing here, I'd say they'd be a little bit more aggressive, and depending on the region. I think I agree with the cultural differences, and I think there's reasons for that as well. But I also don't want to come off as racist, so I'm not going to dive into that because I feel like that's a bad conversation to have on camera. But I'm gonna go up there. I think they'll be sitting around the 50s, maybe 60s.
No,
okay, great.
4%.
4%. Okay. Well, the number he said we're willing. He said whatever they make in a year, we're willing to see a drawdown of up to 50% of that. And I was like, what? Excuse me? And there's me stressing like up ADR in a year.
Of what they make.
Of what they make.
Exactly.
And there was
drawdown on, okay. Yeah,
50% of what they, like annually. So if you said, hey, Rich, you make 4% return a month, we're looking 50% return a year. You would allow my portfolio drawdown to draw down 25% at its maximum before stepping in and saying, hold on. We've got to address this. We've got to adjust the risk tolerance here. And there was me up 70, 80 R in a year, worrying about a 15 R drawdown. It's like 15, 20% of my upswing. And I'm like, my strategy stopped working. I've got to pivot. I've got to find something else. What's this smart money concept thing that's trending now? Maybe I need to learn that.
Hang on.
Are
you saying that this makes you feel you can risk more?
No, this gives me a better perspective of what normal may look like in a pool of good traders.
Yeah, because you need to remember it's a pool. So they're not willing to lose 25% or 50% of their whole portfolio. That's
on a trader.
Yeah, on one trader, which is a very, very small part of their whole portfolio. So that's what's really important to understand. Their risk is still, even if you went and lost 50%, that won't really affect, that will just, like, another trader will probably cancel you out. So their portfolio won't get hit. They're not willing to lose 50% of their whole portfolio, which is the difference here, right? Your trading account is your whole portfolio. If you lost 50% of that, you got a red flag. They've got red flags.
50% of that, you make 100% just to get you back to break even, which is really difficult.
So what they're doing is buying 100 stocks. If one of those stocks goes down 50%, it's fine because they've got another 99 carrying the trade, right? Whereas if you're a sole trader trying to do it that way, that's your whole portfolio. You're not investing in another 99 traders. You're investing in you. So that's the difference there. Don't make sure you don't get caught up in the numbers. Is they're still risk averse as a hedge fund.
You're explaining prop as well. That's pretty much what prop does.
Hedge fund.
That's what prop does. Yeah. You've got an amount of money, and you look for traders that can trade that pool of money, and they're grouped specifically in a given certain amounts of capital depending on their risk and things like that. That's all it is.
It goes back to that conversation we have all the time. Portfolio is everything.
So what can a retail trader do to build a portfolio? If all these big companies, if hedge funds, if prop firms, if personal financial capital is kind of pooling multiples together, what could a retail trader do? Because it seems like a retail trader is stuck in a little rubber dinghy in the ocean, just paddling on their own.
Diverse.
Well, when you say portfolio, I've got two different types of minds though. You've got a portfolio when we're talking about, stocks and things like that you're looking for different assets, but also a portfolio could also be like your playbook, a portfolio of different techniques that you use and different strategies that you use depending on market cycles or depending on trading conditions, and you take portions of your overall capital and assign that to different types of strategies. Maybe if these strategies got a certain win rate or this, maybe you're going to put a little bit more capital to that strategy. If you've got a very risky strategy with very low win rate, then maybe you're going to, that's what could be a portfolio as well, your portfolio strategy.
So more than one strategy. So as traders, do we want to build 3, 4, 5 strategies? Wouldn't that just confuse us?
I like looking at them instead of strategies, just techniques, techniques of, okay, if a market is ranging right now, and how do I identify a range? Maybe 3-point touches, so a touch on a resistance, a touch on a support, it's gone to resistance again, and then it's failed. Where am I going to go? I'm going to take it to its last support. That's a technique of trading a range. If I'm trading an expansion or trading, breakouts or anything like that, I'm looking at getting in a break and a retest. That's another technique. That's in the overall portfolio as you as a trader. What am I more comfortable risking? I'm more comfortable taking the break and retest trade, so I'm going to put more capital towards that. I don't do this, just as a disclaimer. Okay. I put, the same amount of capital I do on break and retest than I do if I'm trading a range. But you get the idea. That could be that's just my opinion of the way that I would look at a portfolio as a trader.
Jordan, what's your thoughts on it?
If you were not to perform as a trader for the next 6 months, how could you still come out on top investing? How can you still make money? That's how I look at it.
Stick it in.
Did he just crash as he said? I think he was about to say stick it in Bitcoin and he crashed.
No. Stick it in the S&P.
Stick it in the S&P. But that's diversification. So that's what that hedge fund's doing, right? They've got 100 million and they're diversifying it across 100 traders, all trading differently, all trading their own style in their own assets. They've diversified. You don't have the ability to do that unless you have 100 traders and enough money to be able to allocate to 100 traders. It's not going to happen, right? Yeah. What you can do is diversify. You can put a bit in bonds. You can put a bit in equities. You can put a bit in crypto. You can put a bit in your trading itself. If you're more weighted, more risk tolerant, and you're performing well, weight that portfolio more in your own bag, sure, and you're trading. But that is the same question every time. If I'm not to perform over the next 6 months, how can I still make money? Most traders are going to say they won't, because most traders are so concentrated. You see this, the best hedge funds in the world, the best investment private equity firms. Now, keep in mind, they've got the capital to do it. So it makes it a little bit easier. It really does, right? But they're never concentrated on one thing and one thing only. Most retail traders are. They're not diversifying. So if they don't perform, which most don't, they don't make money. What I like to challenge is say diversify. So you can still make money even when you suck.
Okay, so let's talk Turkey here. How much money do you need? as a retail trader, if you're looking at really diversifying yourself across the board, we're talking stonks, we're talking stocks, we're talking crypto. You probably need a lot of money for crypto. Stocks, crypto, you've got a day trading strategy, you've got money in bonds, you've got, you're really trying to diversify yourself, and you're saying, hey, I'm a retail trader and I'd like to take $2,000 out of the market, or $2,000 collectively. Where do you reckon you need to be financially? When we're not talking,
I think it's the wrong way of thinking. At the end of the day, you don't know how much a trader. Look, you as a person is going to be, the amount of money that you have is different from another person that can. It's all about percentage of your money, what you're going to do with that money. So if you've got a pool of money, what percentage am I going to risk for this? What percentage am I going to put in this? And that's how you do it. Not thinking about how much money I want to make. It's how diverse do I want a portfolio with the money that I have. The money that you're going to make at the end of the day, who knows what's going to happen? You can't just say, I want to make $2,000 and then just look and try and do something to make $2,000, because you're going to burn, you're going to over leverage, especially if you've got a really small account. The best thing is you take the amount of money, you spread that out, and that's how you diverse. And then, for instance, stocks and everything are going up. I've got a lot of money just from my normal day job here at the Fivers, goes automatically in S&P, very similar to a 401k or whatever in America. Goes straight in there, and that's up. That's up, and amazingly in the year it's up probably like 20% or something like that.
Yeah,
last
thank
time I
NVIDIA
checked.
for that.
But yeah, definitely the whole market is propped up by NVIDIA right now.
35%. 35%.
35%.
35% of the S&P 500 movement is down just to NVIDIA.
It's ridiculous. That's
ridiculous.
That's dangerous as well.
Yeah,
it's actually quite dangerous.
The top 17 stocks in the S&P, I'm pretty sure it's 17. Someone correct me on it. But the top 17 stocks in the S&P 500 are just like the top 17. They're the only ones printed positive year to date. That means all other 480.
Wow.
What? All 483 stocks?
80-20 rule, isn't it?
Are down. It's ridiculous.
Yeah, so 20% of that whole basket is making 80% of the money at the moment.
Diversification.
Yeah. So I tell you what, when I was, I still am very bullish on altcoins. Majority of all my very risky allocation is in altcoins. They have retraced their whole 2014 gains. Now, but my stock and S&P is all up. That's what Jordan is. It just backs up what Jordan is saying. That diversification. If you've got all your eggs in one basket and you drop your basket and all your eggs just explode on the floor, well, there you go. But if you got multiple baskets, little bits of, you've got a bag of here, a bag there.
Yeah.
I'm just picturing Alex with like half a dozen baskets on his arm, running down the road trying to sell eggs. Raisins,
me on a motorbike with a bag of eggs just in one hand. That's more like it.
I've seen people diversify really well with 10 grand. Right. I know your question was how much money do you need, but the answer, the question's flawed. Right. That you can have it with pennies or you can have millions. It doesn't matter because you're going to be trading with it anyway. Right. For example, let's say you have $5,000 in savings, you're getting into trading with 5K, right? We now have the ability to use prop firms. Fantastic tool. Okay. Put 5% over there. That's to your prop firm challenges to get through, try get funded, right? What the other 95%, well, then we can have a look. Okay. We can put 50% in the S&P 500. We can put 30% in crypto, and we can chuck some over in T-bills or bonds or wherever we want, or maybe some individual equities like NVIDIA that we like. That means if you fail the challenge, right? Who knows? But based on averages, your portfolio may have still grown, even including that 5% loss. Could have, right? Now, if you passed your challenge, got funded, got payouts, that still attributes to your portfolio, which means your individual equities or your ETFs, if they've gone down, right, your trading is going to cover that up. And as a whole, you are an ecosystem. You're here to make money. We are here to make money. I don't know how many times I've got to say that. We're here to make money, and we need to do that in the smartest and best way possible, right? And the best way, one of the best ways is to diversify. If you're concentrated, it's more, not only more risk. Yes, there's more reward if it works out, but you're concentrated. it relies on that working out. No other option. When you diversify, you give yourself 4, 5, or 100 traders chance of it working out.
There's he's saying, do you need to diversify when you're investing in the indices, given they're already diversified?
That's actually a really good question. They are. It depends on the indice that you're investing in. So yes, they're diversified across a number of companies, right? And they are. But if you're investing in the DAX, then you are concentrated in Germany. So anything that affects Germany is going to affect all of your assets, right? If you're concentrated on the S&P 500, then you're concentrated in the US. Yes, these companies obviously deal outside of the US as well, but any regulatory changes, any change of president, anything kind of investment movement, wars, US, that's going to affect you. So I still diversify more internationally. So if I'm doing ETFs or if I'm doing indices, I will look to expose myself to a couple of global ones in the event the S&P, the NASDAQ or whatnot do come down. I'm exposed to the ASX 200 here in Australia. I like investing locally. So I'm exposed there. I'm exposed to the S&P 500. I'm exposed to the NASDAQ. I'm exposed to the DAX. I'm actually not directly exposed to the London Stock Exchange, but I'm in an ETF, which does a whole group throughout Europe. And I'm even in some growth ones coming through Asia at the moment. So ETF portfolio, still once again diversified. Does it limit the returns? Yes. Yes, it limits the returns, right? Because you're going to have a few eggs in your basket that crack. You are, right? If you're concentrated, there's less chance of that egg cracking. Sure, it's going to run. But in the event that egg does crack, you win nothing at all. Whereas if you diversify, you can still finish on profits even when a couple of eggs crack. You're muted.
My bad. I feel like a lot of traders are concentrated in trading, like just
Correct.
in trading. Like I need to buy here. I need to buy with leverage. I've got to get in with all the money, all the stop losses, you know, and just ride this up for 56 star and pass the prop firm challenge. I feel like a lot of maybe it's just the circles I run in, but I feel like a lot of traders are really concentrating in that. Alex, we had this really interesting question from Favor in chat. It says, is it possible to trade without losing or trade without hitting a stop loss? So you have the opportunity to look inwards on thousands and thousands of traders. Not what do they make a month percentagely, but if you're saying consistently, where would some of your best traders aim consistently? Not we get traders make 50, 60, 70% in a month, but consistently. What's that number that you say, do you know what? We've actually got a handful of really good traders that consistently could do this over a really big sample size. And it will kind of feed into Favor's question after that, because I want to know, how are they going in with no stops? Are they going in with really wide entries?
It's super, not one trader fits all, man. There's no right or wrong answer. There's not really an answer for that, because everybody is so different. I can tell you one thing. Traders that we see that don't have stop losses blow up really quickly. I think a lot of the traders that are on higher time frames, they last longer. So they're more consistent, last longer. So they hold trades a lot longer. Obviously, short-term traders make good short-term gains, but do blow up the account. So if we ask the question again, what is the bigger percentage, who makes the more consistent gains from a longer period of time? It's traders that are trading 1 4-hour daily, that kind of span. They look at the daily, they're looking for the 4 hours, they're looking at 1 hour executions, things like that. They're looking for bigger swings. In between that, then you've got traders, a smaller portion of traders that are on the lower time frames that can make a lot of money very quickly. They don't last very long though.
Now lean into this, traders. Think about that.
You've got a smaller percentage of traders that, we can say 20% of those traders make 80% of all the profits for that type of trader, for the small, aggressive type of trader. A lot of people get chopped up very quickly on the lower time frames. But again, you can make a lot of money as well. And we've seen traders make a lot of money very fast on the lower time frames. But it's more like they've caught good trading conditions. They've got in, they're making a lot of money during, a couple of months, and that's it. And then we've got traders that are, here for a few years, just trading constantly on higher time frames.
So if we lean into that, we can say that traders on lower timeframes go through boom and bust cycles. They're more likely to go through boom and bust cycles. And now, logically, if the market is always changing, which is what we know it does, it's more likely to change first on a smaller time frame than it is on a higher time frame. So it would make sense in my mind that the traders coming in on the hourly, the 4-hourly, even the daily charts, it would make sense that they're the last people to be hit by a market condition that could change. However, they don't get to leverage a 50-lot trade with a 10-pip stop loss and run it up for 2-3 really good months of market trading. So I understand why traders in smaller timeframes would be boom and bust. I traded 1-minute charts for over 2 years, and that's the exact cycle I experienced. 2-3 months of crazy gains. I had 3 months of over 50R gains, and I was like, this is 17R a month on average over 3 months. I've got this now. I've got this figured out. Now, do you know what I figured out? I figured out the market condition was just right for that 1-minute time frame movement for 3 months, and then I went through about 2 months of minus 10R. And I'm like, what? How does this happen when I've zoomed out and always gone on the higher time frame? The problem is I'm now giving up the 10% monthly gains, and I'm now looking at 2% monthly gains or 3% monthly gains. So I've definitely found a lot more traction on higher time frame trading. So Alex, I love that you share that with us, because I think traders are often caught in that loop of how can I make more? Sometimes more is just dropping the noise, and the noise comes from smaller time frame charts, in my opinion. So, Jordan, you just missed a bombshell. Alex just dropped a big one. And hopefully you caught the back end of it.
I didn't reiterate. I apologize. I was sitting here and I almost peed myself. I was I had to run. But what did you drop?
He was saying no size fits all with percentage gain returns, but traders on smaller time frames go through boom and bust cycles because market conditions change. Traders on higher time frames, hourly, 4-hourly, and daily, typically they make up the majority of the sustainable profits as well. So it seems to be that's the more sort of maturer approach. So it's asking that question: do you just want to make 20K and then just blow up again, or do you want to say, hey, I'm happy to make 2K and sustainably aim for that 2K? I think you have a higher chance of taking a small piece, each week, each month from the higher time frames. So trading without stop losses, very, very, very dangerous game. And I think it's because the majority of retail will look at trading without stops with using leverage. I don't think you can. I think if you're using leverage, you've got to have stop losses in place. So I'm yet to find a strategy that never loses. Get good at losing. Take the loss.
Yeah, I've seen strategies where, and it's worked for a time where a trader has got into a position and without a stop loss, and they've averaged in, and they've got a better overall entry, and it's worked for them for a month, and then eventually they get that one trade that doesn't come back.
Yeah.
And that's what kills them. I've seen it in myself as well. Everything that you're talking about, Rich, I've seen it in myself. I've been a boom and bust trader for years on the 1-minute time frame, just making insane gains that you're like, I've cracked it, absolutely.
Yeah.
But then when market shifts, you may be still in the mind that the market conditions are the exact same, and that's why the higher time frame, if you can get a higher time frame bias and then a lower time frame execution, but understand that you've got to be within the trend, then maybe that could be like a little bit of a hybrid. But yeah, it's an interesting outlook.
Plenty to think about. Lots to think about with that. I like it. I like it. Just a quick side note, I pulled the trigger on the DAX. Why? Because I'm just not done losing money yet on the DAX. I've got to be in this to win it. So we see this beautiful bearish sell-off. We see this indecision candle on the 15-minute, and the market breaks aggressively above. As soon as it does, I'm 10. I want to get in this. I think we can see this beautiful fading of this move back up. We're up about $100. I'm going through a bit of a drawdown at the moment, so definitely need to see a little bit more than $100. I'm going to try and let my trades breathe a little bit further. So I think good place to take profit on this will be around about the middle of this selling candle here. So this would be a one-to-one trade. Got $500 risk on this. We're coming into this higher time frame price point down here. I think the market has made nothing but bullish pressure from here, and I'm looking to see if this price would hold. And we're seeing a nice reaction on it. Now, this is the difference of trading on the 1 minute charts and trying to catch the absolute bottom. I probably would have got stopped out here, stopped out here, stopped out here, stopped out here. I'll be in such a hole by the time I caught the bottom on this that I'm going to be emotionally compromised. Not quite hourly, 4 hourly, and daily. Maybe I haven't got the patience for it, but I know there's edge on the 1 minute, but I just can't get it consistently enough to enjoy the fruits of it. And it just drags me through those boom and bust cycles, not to the point where it blows accounts, but it just doesn't make money. And you know how well you have to execute on a 1 minute edge. Alex, you must know this. The 1 minute punishes you if you're just off.
You got to be super. Yeah, you got to be super. Just that's what you want to do. You see it, you get in. That's it. You don't double think yourself. You just see it, you get in straight away. That's why I think being in my particular characteristics as being a little bit impulsive, not that patient, actually works well being on the 1 minute, because when I see a certain pattern, that's why I don't mind if there is a, it doesn't matter the kind of bias on a macro chart really. If I see, I'll give you an instance. If you turn over my chart, I'll have a look at just on gold, for instance.
Mm-hmm.
At the end of the day, just the little moves of like 10, 20, 10, 15 pips for me is enough. Just something as small as, like when we're seeing price come into this area, just moving up just to break the high. For somebody that's like a higher time frame trader, they're not even gonna look at that and be like, that's a nice trade. For you on the lower time frames, if you're on like the 1 minute, these little trades of just coming to the 200 EMA where it's just bounced, it's got this massive gap here of just nothing for price just to come in, it's held, and then it's just closed that kind of gap and hit the 200 EMA. For some traders, they're not going to waste their time on it. But for somebody that just wants to get in, get out, and it could be what, 30 points. For me, that's a bread and butter setup, and I can look at that, get in, get out, and then I don't have to think about it again. For long time trading, for 1 minute, 4 hour daily, I can't sleep at night when I trade like that, to be honest. But then maybe that's a way of me maturing as a trader as well, because at the end of the day, that is, I think when you mature as a trader, you kind of take a little bit more of an overview of what you're doing. And I think you do have to change and you do have to adapt as a trader. You can't just be a one-trick pony in trading. You do have to diversify the way that you trade and adapt to what you're looking at and what market conditions are giving to you as well.
When you talk about diversifying, I got a question.
Yeah,
how hard do you think it is to find an edge in the market?
I don't think it's that hard to find an edge in the market. I think, basic. Yeah, it depends, but basic, going through, taking the time, the time, screen time, taking the time, taking the data, understanding what is working, what is not, and just executing. And eventually you can find an edge in anything. You've got edges that, some of the guys in here that trade options were talking to me the other day. I lost them when they were talking about some of the stuff that they were talking about in options, and credit swaps and things like that. I lost. I've never, but there's edge in absolutely anything. I don't think it's hard finding an edge. A hard thing is executing consistently when you are a discretionary trader, because you have a lot of emotions, you have tunnel vision, and you have many different things that can affect that particular edge. So that's it. That's what I would say.
Mm-hmm.
Yeah, so I'm letting that settle just a minute. I'm just.
But you talked about edge in diversification, so like you've spanned the ball a little bit as you asked the question. What are you trying? What's the answer you're trying to get from your question there, Rich?
Well, Alex has thrown me a bit of a curveball, because when he said an edge is easy to get, I was like, why is it I always seem to come up with like back testing results of like break even or a tiny edge, and then poor execution would lose that edge? And maybe it's because I was always on the smaller time frame. But then Alex says the hardest part is to execute on that edge, and I was like, I can relate to that. And my mind naturally went to what is the singular piece of work a trader could do to improve the way they execute on their edge? And I know this is such a broad question, because we could talk about greed, fear, time management, risk, just general day-to-day organization. There's so many. I've just let my mind expand into sort of like, how do we become a better trader? Like genuinely, like what is the action step that makes you execute on your edge better? I think it's data.
When I was younger, I went to a new MMA gym in not Nottingham. Anyway, it doesn't matter. I went to an MMA gym and I was sparring with some of the guys there. And when we finished sparring, I asked one of the guys, and this was a pro fighter. I said, "So we've been sparring. Like, have you got any tips? What would you recommend me working on and stuff?" And he just looked at me and he said, "Just keep turning up." That's what he said. Doesn't matter. It doesn't matter how hard you work in that particular session. It's how consistently can you turn up over a long sample size that is going to matter. You can be an absolute beast in in training sessions, but if you stop with the consistency after a month, then that lad that is going to the gym every single time, he may not be that good while you're training with him, but if you stop for a month and take a month break and then come back, he's been consistently turning up and practicing. He's going to be the one that is going to be better than you eventually. And the exact same thing goes into trading. If you're going into trading and you're working on something and then you swap to something else and then you do this and you do that, then what do you expect? All it is time in the market, practicing and learning and continuing, turning up. That's it. It's super simple.
I love that. Turning up and hitting the like button. What great advice that is.
And subscribe. You don't
and
get
subscribe.
You can't be a better trader if you don't subscribe to TradeDelicious.
When you think about people that pop in and out of your life, could be friends, could be family members that you don't stay in too much close contact, and they're practicing anything very deliberately. It could be weight loss in the gym. It could be anything. And you see that person after 6 months. It's crazy to see how small actions compound over time. And it really resonates with me when you say just keep turning up. It's that's some solid. I know we don't do advice. That's some solid advice, Alex. That's some really, really good, insightful stuff. And it's another way of saying there's no short path to digging for gold. You've got to get your back into it. You've got to know your craft. Yeah, I like that. Plenty to think about.
Little wives, oh my God, I was going to say wives' tales, but they're not wives' tales. But my grandma used to come up with these things, like little sentences that, like manners maketh man, or all of these different kinds of saying. And practice makes perfect is one saying that I'm sure every single person has heard. and they keep it into the back of their heads. But it's just true. If all of us have been told the same thing for years and years and years and years, practice makes perfect. Now, there you go.
So what we need is we need this whole space to stop marketing the idea that you can just make $1 billion overnight, and market the idea that actually, if you turn up with consistency, if you find a bunch of people on a similar journey, if you can tap into those that are serious about their craft and just slow down a little bit, maybe zoom out from the time frame you're trading on, you might actually stop wheel spinning. You might just get somewhere.
Yeah, but that's not sexy, Rich.
It doesn't sell courses, does it?
You're telling me it's going to take hard work? That's not sexy. I don't want that. I don't want hard work. I want to sit down, put my feet up, and make millions of dollars.
Has that approach ever worked? Sit down, put your feet up, make millions of dollars. I've never met someone who's had a silver spoon that big where that's worked for them.
I've met plenty, but they start with a silver spoon.
Right. Okay. That's the difference.
Ouch.
Yeah. I've never met someone that's gone from nothing to something with that attitude, but I've met people that start with something and keep something with that attitude. Money makes money. It's the world we live in.
Money makes money.
2% to us, it might be nothing. It might be a little bit in your portfolio you're trying to grind. If you're doing that with 100 million, that 2%, you're laughing. You're laughing. It's 2%. Yeah. You look at these bonds, you're like, I'm not going to get in that. They're going to give me 4% a year. Yuck. I don't want 4% a year. That's not going to get me anywhere. But if you had $1 billion, all of a sudden that 4% is a lot sexier. Money makes money.
I think Graham has the right approach. I find I do the best when I'm not in front of the computer, when I'm in a trade. My best results come when I forget I have a trade open and I wake up in huge profits in the morning. I love that.
That's concerning.
There was, I think that I can't remember what book it was, but there's a book, I think, The Psychology of Money. And in that book, it says the definition of successful stock investing is when you lose your password to your investing account, when you're just not looking at it. And suddenly one day you go in and just by compounding and not touching it, suddenly it's actually something. Coming in and out and trading, you could probably make good money in the short term, but over the long span of things, you can't beat just overall just investing and compounding. You just can't. Just time in the market is better. That's all it is.
I'm trying to apply that at the moment, Alex. I've changed my phone recently, and I've lost access to my crypto wallet. And I'm like, okay, I'm going to forget about it. And Alex comes on every time, like, crypto's tanking. I'm like, I don't even want to look at it right now.
But there you go. That's a good example of being super exposed in altcoins, but I wasn't exposed to Bitcoin. That was my mistake this cycle, because last cycle altcoins, this is going into the attitude that maybe this cycle is already up, which I don't think it is. I think we've got still more to go. But at the moment, if we've looked at when Bitcoin is its lowest, it has outperformed altcoins drastically so far. Altcoins have pretty much retraced, and because in previous cycles we really saw a massive push with altcoins very early on in the cycle, and I had that in my mind. My mistake this time was having no exposure to Bitcoin. And, that's diversifying as well. Bitcoin, having Bitcoin and then maybe rotating the gains into Bitcoin into potential opportunities on lower cap or altcoins or things like that would have been a better. But again, now I've been in another cycle. I've got more information. It's just going to happen. If I'm still trading, I'm still doing this stuff in the next cycle, it's just going to make me better. And that's all it is. That's what we said. It's the practice. It's the screen time. It's somebody said to somebody, I can't remember. Somebody said something like, basically where I'm getting at is you create your own luck by just spending time. People are going to look at you and like, wow, that guy's really lucky. They don't know how much money you've lost. They don't know how much time you've been in front of the screen. They're not going to know anything. By the time that you make it and by the time that you're making more money than them, they're going to think you're lucky. But they don't know that you're not lucky. You're just a hard worker. That's where I'm getting at. So
yeah. Graham was saying, where can I get this silver spoon that you speak about? Well, mate, there is a queue probably with about 100,000 people long, all queuing up trying to get that silver spoon. You want to join the queue that has about 2 people in it. You know, that's the narrow pathway that you just got to grind. But Alex, you were talking about Bitcoin.
Pepe.
You left it out. Bitcoin is the higher time frame. Like that was your higher time frame asset, and you're in on these altcoins. They're like the 1 minute charts, right? Not saying you're trading the 1 minutes, but they're as risky as the 1 minutes. High plays.
No, do you know what? Again, it depends. It really does depend. Like I'm in some altcoins that are still up like 200-300%. Solana, I got in on £17. So I'm still up really, really good, but you've got some others that are down really bad. I'm down on Sand, which was a gaming token from last cycle, which I thought was going to pop off. I held that position probably for about two years, and it's still 80% down. I actually just ended up cutting that because what am I going to do with it? It's literally not going to move. Sand is not going to come back. Also, Ada, I was in that position as well for like 3 years. Some things once hype has gone away, it's best to move stuff into things that are actually got more potential to move. But again, it goes into the same things as Jordan keeps saying, as diversification. Instead of having all your eggs in one basket, I have two coins that have done 80% of all the gains. Everything else has just been stagnant, but they've made the whole portfolio, and everything else has just died. So
yeah. While you were chatting there, I just checked my equity portfolio. So that's not including anything else. I've still yet to expose myself to crypto. I want 7% in crypto. I'm still yet to do that. But I've just checked the equity portfolio. Not done any trades. I'm completely flat on my trading day today. Right. My equity portfolio, I'm up $700 today. I've done nothing. Absolutely nothing. So now I can feel like I can head into the trading day. Right, I've got $700 to play with straight out the gates. Even if I went down $500 today and I had a losing day, my portfolio as a whole is still going to finish in profit. Right, don't get me wrong. There's other days I'll come in, I'm $700 down on the day. Right, and then I'm going to have to mitigate that and get it back up. But that's like I didn't do anything for that. That's just sitting there. That's doing its own thing. And it is part of my portfolio. It's part of my growth, and that's what I want most traders to get to. Like it's just so important to diversify.
And there's me having to work to get this DAX to close at like $450 profit. I'm actually having to do some work today, Jordan, to try and get this profit in the account. We did see a nice little push up on the DAX, managed to take 1-to-1 on that. Sorry, Alex, just want to share that. Yeah,
I just think I think the thing is, start for you, Rich, I'm talking about as well, because you're a diehard trader. If you got loads of money, you would take it and you'd start trading with it just by maybe splitting some of it up and just playing around with the ideas of maybe I'm just going to put something and just forget about it each month into an ETF. That's everybody can just get started with that stuff, just really just starting to get their toes wet, and then suddenly to see, what, now my trading this month isn't going that well, and you just open that portfolio and what, actually it hasn't really done anything because now I'm break even because it's just hedged, so
I find it really fun, like to buy into a company, individual equities. I like researching them, buying companies, something you use every single day. Like I actually enjoy doing that. Now I don't do anything. I just buy it and hold it. I'm just a shareholder in some of these companies, right? But like, look at some of these companies. You don't need to be exposed to really risky crypto coins or some crazy schemes in order to make a lot of money. Nvidia. Look at Nvidia, fantastic company, something you generally want to be invested in. It's up 700% over the past 13 months. 700%, 7 times your return in 13 months. I can't do that in my trading account. I don't know about you guys, but in I think it's actually 15 months, the exact number. But if you give me 15 months to 7 times my account, I'm not going to be able to do it.
Never.
But you could just buy one thing 15 months ago and not do anything, and it will do it for me. Keep in mind, I diversify it, right? But that's kind of what I'm getting at. It's also fun.
I don't know. I keep making money. in profit. Maybe if I get days back to back like this, that might be an opportunity to do that. But
it's also investing is like position. You're still trading. You're just position trading,
Yeah.
Unless you're holding, for a long time. But position trading is basically, holding for 6 months, 12 months. That's a position trade.
Alex, you were screwing
You're
your
still
face
trading.
up when you were saying that. You were like, position trading. Like, I could see it was a difficult thing to get out of your mouth.
That's what my spot trading on crypto. They're position trades. They are. I'm not
They're
going to hold these
unleveraged?
forever. I'm looking. Yeah, all my spot trade. They're all unleveraged.
Oh, nice. Okay.
My day trading, my small amount that I would put to futures day trading. Do you know what? I can honestly say I made so much money, crazy on that portfolio. I made like what 50% in a really short amount of time, probably about a month, and I blew it all within 2 days because of some really silly risky trading. I'm talking about all the profits on that futures margin account. Not bothered because all my spot is up there, and I'm happy with putting a little bit of money just to some more riskier trading to see if I can get. That's what I'm talking about. Some of the best things are just buying, position trading, especially if you're looking at things like that. If you want to day trading, forex and things like that, they're fine. You can do that. But when you're trying to day trade certain types of assets, also they're better to have a longer span, a bigger outlook instead of just being stuck on a 1 minute, because these things, you have to have the right asset as well for the type of trading that you're doing.
Yeah, and I apologize. Des has hit the nail on the head. This show should be called Invest Delicious, and I apologize. We haven't really talked trading, right? We haven't. But the reason the reason we haven't is because we care, and we want, like, we're in this business to make money, and trading isn't always the direct answer to make money, right? We love it. I will never not. Right, I love trading. I'm everything in trading. I think this is the real edge, and you can make money, and that's why I still allocate a lot of my portfolio, some of my portfolio, to my trading. Right, you should be a part of it, and you're right. But like, we're here to make money, and we're showing you ways to do that consistently, and sometimes with less effort. And a lot of people are in trading solely to make money, not because they love trading, but just because they want to make money. There's easier ways to do it. There's easier ways, more passive ways to do it. So I'm just shining the spotlight. But you're right. But if there's anything to go by, I mean, while we've just been chatting, Alex is up $1,000 on his gold position, and Rich is closed in $950 during this live trading session. So you say it, but he's also made money. 939 was it? Yeah, 919 after commissions.
Yeah, I think at its core, trading is just my investment vehicle to try and build a pension pot, a passive income, whatever you want to call it. I want to get to a point where trading supports. I work as a trader, have done for 6 years, 12-hour days. I don't want the next 6 years to be 12-hour days. I want to get to a point where, that 2% return a month is substantial enough for me to go, hey, do you know what? I only need to do a little bit of diversifying and investing. And that's why I love when we have these conversations, because it's about broadening my perspective of, Rich, you're a very concentrated trader. And I'm like, that reminds me, trading is just my investment vehicle to try and build capital to put into other ventures and diversify myself. One day I might find something that financially beats the return pound for pound in trading. If I get £1,000 a day in trading, what if I could get £500 a day doing an hour a day at something else? Then my time is better spent to trying to compound that other thing, or just saying, actually, I only need so much. Let's get life balance. Let's have a quality of life. Alex, I said to you not so long ago, what would you do with 3 million? You'd like, I'll be on some beach somewhere. Do you know, that's man after my own heart. There's a part of me that's like, actually, I don't want a 12-hour a day job for the next 30 years. It's a quick way to just blink your days away. So trading is a great, I think, early tool, but it's not the end goal for me. I think it's the investment vehicle I'll use to try and reach that end goal for building capital.
Yeah.
Tough way to do
it.
It is.
The evolution of a trader normally goes from getting into trading, losing a lot of money, get to break even, get to being profitable, teaching other people how to trade, using that for their trading account, eventually stopping trading, opening other businesses, and so on and so forth. Trading as a skill, you probably won't make the kind of money like somebody that has got that skill now and is going to teach another person how to do it. Honestly, you're really probably not at our level, but that's okay because you're still trading. At the end of the day, you're trading your skill to teach somebody else as well. That's also a trade if you look at it. And amount of people that are, if you're going through a journey and you unlock that, that skill, and you've got a framework and a plan to help somebody else lock that skill, that's another version of your trading that you can evolve into, and that will also make money. You can then use that. That's another diversified way of building up your investment portfolio. Relying just on trading especially is super, super difficult because you don't know, especially if you're a discretionary trader, because you don't know when you're going to perform and when you're not going to perform. And you can have a couple of months where you're doing very, very, very well for yourself, and then you can have a lot of when you're not. So also that's something as well just to think about. That's why I never. Well, what did Des throw in?
Sorry. You're not in trouble, don't worry. He's thrown in saying there's huge well-being benefits to being in control like you are in trading. I agree, but there's also massive well-being downside to being in control. Don't get me wrong. Like, yes, sure, you're your own boss. You can make your own money. You can do that elsewhere anyway.
A lot of stress.
But the stress, the performance pressure, everything else that comes with it. You know, if you've got a family to feed and you're not performing, is that going to improve your performance? Probably not. It's probably going to stress you even more, right? I'm going to say this from a male perspective. The older I get, the more I feel that urge to provide. Right, the more I feel that urge, I need to set up my situation so I'm able to provide for multiple people, right? Whether that's right or systematically right, I don't care, right? But that's how I feel as a person, and that's what I'm going to do. If that was solely reliant on my performance to pull the trigger on a 1 minute chart on US dollar Japanese yen, I don't feel I can sustainably provide for 4 or 5 people with that pressure on my shoulders. So I diversify. I change things up. I mitigate risk.
Agree. 100% agree. I couldn't express it in better words, man. 100%.
It's interesting you picked the pair USD JPY. That was the one you said you were in touch with the Bard's file. What's going
on? Yeah, Japanese yen. It's fresh in my mind because John's buying it right now, and I, you know how I feel about the Japanese yen, so I was giving him some stick.
How's it doing? Let's. I got a UJ chart here. So he's buying this.
Yeah.
Okay. It's pulling back slightly. I mean, it's on this beautiful bullish run. I'm not sure where he bought it.
Scott's getting the game. I think he's aiming for the 159s, but I said anywhere up near 160, I would not want to be exposed to the Japanese yen.
59. He's got to break this high. 159 is like all the way up here.
We're macro traders, Rich. Come on.
Yeah, true. There's me zoomed in too much.
But yeah, that's why I said US dollar Japanese yen. It's fresh in my mind.
Des is saying I'm still holding GU longs. Sad to see you're off board so soon. Thought we were going to enjoy this ride together. There's one thing you should know about me, Des. I'm looking for that quick, easy move. If I zoom into the 5 minute chart on this and zoom in here, show the chart history, you'll see. Managed to catch this move here. I thought this was going to be the one to the upside. Market leg down. That's that smart money trap we were talking about yesterday. Maybe it's a thing. Maybe it's not. It'd be simple enough to backtest it to find out. Well, my stop was nice and wide. So supply and demand are the best. So I was getting in here and then just looking for the market to run up higher. And I like that you're holding this, but on a lower time frame, I was anticipating the market would come back and bounce at this price point. This is the reason for that exit. When the market pulled back 5 pips, I didn't have to sit in it. That's a $250 pullback based on a 5 lot position. So hopefully this continues to the upside for you. I'm pretty pleased with myself for managing to catch the market at this price point. I wouldn't want to sell from here, but I definitely like that the market had to come through and at least touch and test it once before being able to move.
Can I set a challenge for you tomorrow, Rich?
Yes, sir.
On the live, you and Will tomorrow?
Yep.
I want you both to start the trading floor straight out the gates to open a 10 lot position, and your whole job is across the hour and a half to get out of that position at the best prices.
Oh, that sounds
so I've got to keep a 10 lot position open.
that sounds super scary.
So you're gonna have a 10 lot position open, and your job is to get out at the best prices, right? Not the whole thing. You can take 2 lots here, you can take 3 lots here, you can take a 0.5 lot around here, but your job is to reduce the risk, reduce the loss or profit on that position to get out at the best possible prices throughout that trading day. And the reason I want to put that challenge forward, because I think it's going to be fun for the audience to watch as well, but it's going to change your mindset a little bit. But rather, I want to buy around these areas. When you're in the position, you've got to mitigate that risk. Have a look at how you read the market a little bit differently, and you'll read it a little bit differently because you know your strategy, but you'll be looking at it thinking, is this an area where I should be reducing or even more exposing? You know, I want to get the best result out of this. It'll be a good activity for you guys to do.
So 2 lot positions, 5 of them, scale in and scale out. Yeah, I'm trying to find a loophole here, Alex.
Like literally open straight out the gates, euro, US dollar. The moment you go live, buy 10 lots. Okay. The next hour and a half, your job is to get out of that position at the best price possible over the next hour and a half. You don't know where that's going to be. You don't. So, but you got to play probability, right? You've got to scale out of that position at the best possible price. What it's going to do is make you analyze the chart trying to get out rather than analyze the chart trying to get in.
Never done that. I've always been around the entries, not the exits. So this will be a super, super cool training drill. Okay. I really hope I don't give back this $1,000 I made today.
All right, but do it on another account or something. But the exercise is really powerful, right? It's really powerful. How you read price action, how you plan things a little bit differently when you're trying to mitigate risk rather than expose risk.
Okay. I'm down. Challenge accepted.
Challenge.
I'll break the news to Will on the back of this and get him all geared up. I hope Will's got an account big enough to stomach 10 lots.
I've seen Martin's come in and said it's easy, just close the position 1 second after opening it. Yeah, but if it moves all the way up, then you've not executed that position properly. You could have made a lot of money in that position, right? What I'm trying to say is you don't know where the chart's going to go. Like, we never know where the chart's going to go. Your job over the next hour and a half is to get out of that position at the best possible prices. Imagine I'm a hedge fund. You're the technical trader that gets our entries. I say, I want to close our position in the euro throughout today. Your job is to find the best prices to get us out. Yeah.
Okay. This is easy. This is super easy because chat has 100% win rate. So when I rock up tomorrow morning, I'm gonna be leaning into their analysis. But okay, sounds like a challenge. I look forward to it. We'll be hitting this tomorrow. We're going to take a 30-second break. We'll be straight back, joined by David and Aaron Alex. Thanks for joining us today. Thanks, Jordan.
Cheers. We're going to make some money today. I'm going to try and make some money today.
I've gone through the top-down analysis. All these levels that I drew in is straight positions. We are trading right within value. Would make you feel much better.
They're forecasting a little bit of that.
It's been a monster move. So don't worry, Rich. I took it for you. It's going to be a little bit more aggressive
on how I go about the analysis.
Good morning, traders. Thank you so much for joining us here at TradeDelicious. Super excited to get the ball rolling with another episode of Not Buying It. Hope you're doing well. I'm your host with the mostest, Aaron, the incredible man to the left or the right of my screen, depending upon the orientation of your screen, is the incredible profit professor, the Duke of Dollars, the David. How you doing, sir?
I am doing so well. I happened to catch the tail end of the stream there, and every time I come onto the TradeDelicious stream, I hear things like Nvidia up 700%, and people are talking about things, and it was kind of an extension of the conversation that Rich and I had a little bit yesterday, in terms of not relying solely on trading to provide your income, but diversifying the ways that you make your money. And it's really, really important, because I think that not only relying on trading profits really kind of help that thing along, help your trading. You're not really stressed out about the trading. If you have other ways to kind of keep the lights on, trading is a good way to make money. That's why we do it. That's why, that's why we're so invested in these markets, both figuratively and literally, because we love the idea of being able to kind of dictate our time and how our day goes, but at the same time, finding ways to make that easier, including the diversification of that. How much mailbox money, I call it mailbox money. What they were talking about was, how do I get that mailbox money, right? I'm talking about rent checks. Fair. I'm talking about like dividend checks. I'm talking about like things that come on a recurring basis, right? That's what I call mailbox money. The more mailbox money you have, the better off you're going to be in terms of your trading and where you're going out and acquiring money. And so the acquisition money, or money we acquire, is a little bit different than that mailbox money. And the more mailbox money you have, then maybe you can keep your hair. Maybe you don't lose all your hair like I did. So you look at that. I just love it. And I love what we do at TradeDelicious, because these are important conversations to have. And you have people here that enjoy trading telling you that, yes, trade, do your thing trading, but also, diversify a little bit and look for ways to kind of do this over time, so that you're emotionally and logistically sustainable in this game for long periods of time, instead of a short, a good time but a short time. But yeah, feeling fantastic.
Yeah, I can't agree with you more. Someone who is incredibly near and dear to my heart. I often talk about him on this channel. I'll be dragging him back on at some point. There's someone we had come on several times, this gentleman by the name of Don, incredible trader, been trading for something like over 35 years now. Really impressive futures trader, a man that I took incredible amounts of inspiration from. We used to do a series called TradeDelicious Bites, where we would just talk about where we were in the market, break down a little bit about futures. It lasted for a few months, and his schedule changed, so we couldn't do it any longer. But he did a breakdown for me one time, looking at my trading and my statistics. And he asked me, what are you doing outside of trading? At the time, I was doing nothing. I was just trading solely for my income. And he told me, what if you didn't? What if you had another source of income that you could depend on to pay your bills? And what if you allowed your account to compound within itself? What would that look like in the next 10 years? And having that conversation, that outlook, really changed the way that I looked at my own trading, because it's great to be a trader and be able to pay your bills from your account, but that's another degree of stress. If you have to pay for everything through your trading, you have to do well today. There really aren't many options. So that additional stress sometimes results in less performance, because that additional pressure exists. After that conversation, I put my big boy pants on. I got a day job again, which was not exciting at all. Wasn't happy about that, but now I'm able to have a little bit extra in my trading account after every month, allowing that size to build. And I have a 5-year plan now, where the focus is no longer to just make oodles and noodles of cash and pull it out of my trading account, but to compound it in the trading account now and use profits to do things like investing in dividend stocks, investing in treasury bonds, investing in corporate bonds, so that I'm receiving payments from a multitude of different areas and not allowing myself to just be a one-trick pony. I think it's necessary as traders, and a lot less exciting than a lot of the other stuff.
Than 1 minute charts and making thousands of dollars per tick. Absolutely. So why don't we get into it? Let's get into the episode and see what we're buying and not buying it. I will go ahead and I will volunteer to be the first victim, and we'll talk about the first equity we have in mind. And I'm talking about Celsius Holdings. What Celsius Holdings, it sounds like something really scientific or whatever. It's an energy drink company. Celsius Holdings, again, when I looked at for things to bring on not buying it, I'm looking at things that are just people are talking about, or things that have had a lot of volatility here lately, and trying to figure out what the answers could be, or whether or not I would like to buy the dip or not. And there was a couple things that I was like, hey, I want to buy the dip on this. I like the idea. Home Depot, prime example. I believe in Home Depot. I believe that it is a good company, and it's going to be here for a long time. I use the product, right? I go to Home Depot to buy things all the time when I'm doing things around the house, that kind of thing. Back when I was a homeowner, now I go there less often and more. It's just because I just like the idea of going there and checking out what they got going on. That being said, let's look at the chart here on Celsius. We just we double topped not that long ago. Double topped here at the end of May. Towards the end of May, up here at the $100 level. I'll just call it a double top at $100. And up until that point, what we had was a series of higher highs and higher lows for the most part. We'd had a bit of consolidation late last year, and then a bullish run at the beginning of the year, pull back into April, and then really just and I think this was probably an overextension. I think a lot of people saw this pullback, and this is classic, right? Support and resistance type trading. You pull back here, you see this top around September of 23 in and around the $70 level, $69 level. People kind of piled in there, and then that kind of precipitated the rally back up towards that $100 level. So you got the retest of the 100. We failed that level, aggressively sold off. And you can kind of see this day, a lot of panic selling ensued on this daily candle here. Look at this here, like just selling on heavy volume. And we've pulled back ever since then. And that's even after earnings. Earnings was way back here on the 7th of May. And this was a post earnings move. But what happened here is quite a few things, but not necessarily specific to the company. And again, I look at the 50 period and the 200. If you look at this, you're like, man, this looks healthy. 50 above the 200, longer term stability on the daily. But now we've just fell to 200. We fell right through that bad boy, and we're now to the point where we're at these previous resistance points in and around the $60 area. If we fell here, we could fall as low as that $48 area, which at that point, maybe from a technical standpoint, if things have changed with the way I feel about it, I would look to buy at that point if we get a longer period of consolidation. On a downward trend like this, I mean, a very extreme downward trend on the daily, I don't like it from a technical perspective. I like it from an on-sell perspective because we've fallen off so much, but the sentiment has really soured on Celsius. So again, Celsius sells energy drinks. I don't know if they're in markets outside of the U.S. I just know that is one of those. They do a lot of things with like YouTube influencers. I like to golf. I like to watch a lot of golf influencers, and I know that a couple of them have been sponsored by Celsius before. So kind of in the right market with the right people. They don't really invest too much in like mainstream advertisements on main networks. They do it through YouTube, and it's shown to be kind of a quite effective way of advertising a product to a younger audience, because a lot of us are just hanging out on YouTube and doing things on YouTube versus legacy TV. When you look at something like a Celsius, they did report they are up. Revenue's up 60% year over year. Gross margins are up to 51% over 43%. So in terms of like what it's actually doing in its money, let's just call it its money. It's actually doing really, really good. Earnings per share is up to 27 cents, up 100% year over year on earnings per share. Actually, as I look at this international sales, so they are in international markets, increased by 43% to 16.2 million. Looks like there's a little bit more growth to go on the international side. So Celsius looks like it's expanding its market share in a highly competitive energy drink sector. in the US, it holds about a 12%, 11.5 to 12% share in the US energy drink market. Again, significant increase from the previous year. The company's products have performed exceptionally well in the club and online channels, with Amazon sales increasing 30% year over year. Amazon being a very visible way of purchasing a product, right? So now I can sell my product effectively in an easy market like Amazon. So looking there. So new product launches, new flavors. So yeah, and then expanding its international presence, entering new markets such as Canada, Australia. Jordan, watch out. You're going to be drinking Celsius soon if you're not already. France, Ireland, New Zealand, and the United Kingdom, according to NASDAQ. So Rich will be drinking Celsius too if he's not already. So again, you look at something like this and I'm like talking it up, but the numbers kind of show themselves. But I don't like the idea of the industry that it is right now in terms of buying dips in something, right? Energy drinks. Why would you buy the drip in the energy drink space when there's so many other things that are just kind of popping off? It doesn't pay a dividend. So now you're really expecting the stock price to grow. So this isn't not a portfolio play. If anything, this is going to be more of a trade play. I'm not going to hold stocks in my portfolio that don't pay a dividend. It's just not my cup of tea. But I will position trade or swing trade something, where I'm looking for the stock price to really kind of accelerate from there. But where does it grow from here? And that's really the question in 2024 is like, okay, well, if we're looking to pivot into international markets, that's great. But our markets right now is we talk about, this is a consumer based, right? Like you and I have to be willing to buy this beverage from the counter off the shelf. Energy drinks have kind of fallen out of favor a little bit due to the fact that we are a bit more health conscious. We talked about all of these weight loss drugs that are out there. A lot of these drinks are 0 calorie, right? But now we're going after the artificial sweeteners, and we're like, hey, do we know what this artificial sweeteners really are? What are they doing to our body? And I still personally have the Bang energy drink bankruptcy in mind. An energy drink. Red Bull, when it first came out, was catered to the younger audience. Aaron's flavor of the year is Red Bull. We know how much he loves the flavor of Red Bull. I say that. But you look at it, right? But what has Red Bull done? They've diversified from yes, it's the energy drink, but they got a soccer team, they got this, they got that, they got all kinds of stuff going on. So they've even diversified. They've taken their money and diversified into that lifestyle. Can another energy drink company, Monster, kind of the same thing, Monster energy drink. You look at that and it's doing kind of the same. Kind of the same deal. And one, again, what's really happened lately with Celsius and why we saw a lot of these price action in Celsius is that, everybody from like Morgan Stanley, Stifel, Wedbush, Jefferies, TD Cowen, whom analysts at these companies have all basically kind of come in over the past couple of weeks and lowered their price targets from 75 to 68 for Morgan Stanley, Stifel from 95 to 85, Wedbush from 85 to 83, Jefferies from 104 to 98, TD Cowen from 95 to 85. So what does that mean? So everybody's coming in here and they've all lowered their price targets on this thing. And that is, you look at it at the chart, you're like, well, if all these analysts are coming into the stock and they're lowering their price targets, I don't want to be involved with it. So is it an overreaction? Quite possibly, because I just showed you the numbers where they're at. But once sentiment shifts on an equity, if you're in it, you want to get the heck out because you don't want to be caught bag holding. And that's kind of where we're at with Celsius.
Bag holdings, it's absolutely horrible, especially when you believe that the stock has potential for growth. And I agree in the space, especially going against someone like a Red marketing perspective, it's so hard to compete with the Red Bull. I am a really big fan of Red Bull. I drink a ton, way more than I should. And a large reason for that is because of the fact that the marketing is incredible. I'm a really big Honda fan. I love racing. Honda, Red Bull, they've been a partnership for years. I don't even like the racing team, but I love racing. I love, so many aspects of their marketing plan. And so it's hard for me not to support the business model. Switching gears a little bit, talking about something that's a little bit less exciting than something like a Celsius. You guys know how I feel about the incredible bond market. Today, I'll be talking about the 30-year bond futures and some of the opportunities that we have in these futures markets. Now, when we bring everything over to futures, there's a lot of things to consider here. So this is looking at the 30-year. The benchmark is the 10-year, but the same ideas apply here. We're looking at long-term bonds. The 10-year, the 30-year have very, very similar yields right now, which is irregular. It's irregular, but it's where we are today, considering our really unique conditions with so much in the way of value on the Federal Reserve's balance sheet in terms of how many bonds they're currently holding from the U.S. Treasury, along with our inflationary situation. We'll be talking about this for months on end. We'll be talking about this for more months on end as interest rates continually stay at the level that they've stayed at, the highest that we've seen in years. When we actually look at the chart, there's a couple opportunities that I saw here. Opportunity for this double top here. We have to remember that interest rates relative to bond yields are inversed. So at the idea of interest rates being staying consistent or rising, generally speaking, we see bonds fall and vice versa. So there's a lot of interest about bonds right now because of our current inflationary condition. I cannot talk today, but this is a really, really valuable opportunity in my eyes. When you look at the cumulative delta, we're definitely seeing a lot of buying coming into the end of May, into June. Only one very aggressive selling bar. So I'm curious to see whether or not sellers are able to maintain the space here, especially with all the news that we have going on in these markets. One thing that plays a huge role in the value of bonds and the bond performance has to do with the Federal Reserve's balance sheet. I spoke about that a little bit earlier, but this is a chart developed by the CME, the Chicago Mercantile Exchange. We use a lot of their tools, including the Fed tool, to determine whether or not we're going to see cuts in September, cuts at any point during the year. This chart looks at a big piece of the puzzle that we don't talk about all the time, the fact that the Federal Reserve has been quantitatively easing the market since 2008. What's quantitative easing, Aaron? That's a big word. Well, quantitative easing is when a central bank, the Federal Reserve, the Bank of England, the Bank of Japan, when they come in and they start to stimulate the market by purchasing bonds from the monetary arm of the government, the monetary arm being the U.S. Treasury in this case. The U.S. Treasury issues bonds as a form of fundraising. Basically, they take on that debt in order to make sure that the government can continually run. Don't ask me why we can't run off of our own taxes, but that's another discussion for another day. What happens here is 2008 happens. 2008 was an incredible crisis. Of course, the Federal Reserve decides to come in and start quantitatively easing in order to make sure the market stays strong. That's this light blue line. As time goes forward, they continually try to ease things for the market, start to offload some of their positions right around 2015. As we get further into 2020, we see a low, and then this thing spikes up with some immense aggression. This low here coincides with an incredible low. This is something like a 24-year low on the 10-year Treasury bond yield. This is actually mirrored on the 30-year as well. So as we see this chart begin to find pullbacks, it wouldn't be surprising to see Treasury bond yields continually find strength and or level out. This chart is just a very, very interesting opportunity to look at how federal balance sheets relative to the 10-year yield has performed. Obviously, the correlation doesn't make too much sense, and that's why I wanted to bring you guys some additional charts so you can further understand what I'm talking about here. This is another chart looking at PCE growth. PCE being the benchmark that the Federal Reserve looks at in order to determine whether or not we're hitting their inflation targets. As you can see, things level out quite a bit when we look at different times where we've seen more stable inflationary conditions. In 2000, yes, absolutely, we had the dot-com crash, we had the dot-com bubble, but it was a much more stable time from an inflationary perspective. And let's face it, dot-com bubble was bad, but I do not believe that losses were as aggressive as they were during the 2008 financial crisis, because the 2008 financial crisis involved mortgages. Everyone had a mortgage. Very few people, very key people were involved in the dot-com bubble in 2000, and NASDAQ was a relatively new thing. It wasn't as widespread as it is today. So the losses during the dot-com bubble were, relatively speaking, smaller and more concentrated. During those times of more stable PCE, we see the Treasury bond yields have considerably less in the way of volatility. The same was true into the 90s. There wasn't as much craziness happening in the 90s. We were looking at 2 to 3% inflation. But as we saw things level out, we saw PCE growth continually grow. We saw the 10-year stick quite closely to the performance of PCE. As we see different banks, the Bank of England, the Christine Lagarde, as we see the Bank of Canada continually focus on cutting rates, and we see stability across the globe, there's a possibility that we can get back to this relationship with PCE. As PCE comes up, there's a possibility that we could see the 10-year yield, the 30-year yield, other bond yields continually find strength as well. When looking at things, I talked a little bit about the balance sheet and where we're at, showed you a little bit about the chart, but this is actually where we are in terms of how much the Federal Reserve has on their balance sheet today. Today, that number is a gajillion dollars. It really doesn't matter what this number is. It's a massive number. We're at 7,258,974 million. So this is billions of dollars in assets that they have on hand. I'm sorry, this is trillion of dollars in assets that they have on hand. It's an incredible amount of dollars and cents.
If any number actually looks like a cajillion, this is what a cajillion looks like.
What looks like a bajillion. It's preposterous. So I just wanted to show this just to make it clear that we were looking at just very small amounts of billions back here, and now we're looking at it's gotten insane. When we're talking about things that could affect bond yields, there's a lot that could affect bond yields. The core of those things are going to be centered on very important economic calendar dates. We have a lot of news coming out this week that could be affecting the Federal Reserve's outlook on potentially cutting rates. That feels like every week, but it's just the reality of the thing. We've already seen New York Empire State Manufacturing. We've already seen New York State Manufacturing. We've seen a couple members speak. Today, we'll be seeing core retail sales month over month. We'll be seeing a lot of numbers in terms of initial jobless claims, the Philly Fed manufacturing, PMI out of the S&P Global US manufacturing, existing home sales, a lot of very important numbers. But more importantly, we're seeing a lot of conversations and a lot of speakers coming out and having opinions on where they believe the market should go. Now, all of these people are not voting members of the Federal Reserve, but all of these people are Federal Reserve presidents. Just today, we're going to have the head of the Richmond Fed talk, the head of the governor of the Richmond Fed talk as well, both voting members of the FOMC this year. We're going to have the Chicago Fed president talk as well. And in total today, we're going to have 6 regional Fed presidents and Fed governors speak today. So look, none of these people are Jerome Powell. None of these people are His Royal Highness. So their opinions are considerably less important than Jerome's.
But if they're voting members, though, this is what people have to realize. If they are voting members, then you do have to take into account what they say, because that is sentiment that's going to go into the room and try to persuade others to come over to their way of thinking. Because while Jerome Powell is the head, he's not a czar. We pay attention to him. But so when it is a voting member, that and I say that, and I had to just kind of interject here, because days like this are very tough to trade, because if I'm spooked by it, so are traders. You're gonna get price action that reacts to things that they're saying as they're saying it. So if you're not plugged into some sort of news wire while you're trading, things could move in that short-term volatility. So it might be something where you reduce your risk a little bit, or trade a higher time frame so that you could absorb that bit of short-term volatility in and around that minute candle that somebody happens to pop off with something that the market may have either loved or did not love.
And that's a really good point, because today we actually have the St. Louis Fed head, Alberto Musalem. He's going to be talking today. He is brand spanking new. So, a lot of these people, a lot of these Fed presidents, these Fed governors, they're media trained. They don't come on and slip up very often. We see very, very, very disciplined comments. We're going to do X, Y, and Z. What about Y, Z, and X? Don't worry about that. They're very good at answering these questions in a very specific way, as to not move markets too aggressively, because they don't want to be the cause of immense volatility. But my guy, Alberto,
he might day one on the job. I remember whatever job I've ever done, I still remember my day one, and that's not, you're not always as polished on day one. So, you do have to kind of take that into account. So that will be very interesting to see what happens on that day or today, to see if he slips up and says something. And that's why, make sure you always trade with the stop. But I think on days like today, it might be a little bit more important to kind of look at that, make sure that you do.
100%. I mean, six Fed presidents, six Fed governors. It's a lot. It's a lot. Most of the voting members are going to be speaking today. We'll be hearing from everyone: the Boston Fed, the Dallas Fed, St. Louis, Chicago. It feels like the only person we're not hearing from is Atlanta and New York, because they spoke yesterday. So we're seeing a lot of numbers there. It's a fun one. All in all, we're looking at the U.S. yields. U.S. yields as of yesterday advance as markets consolidate ahead of all these Fed speakers. So there's going to be a lot of potential volatility in these markets, just looking at things from the perspective of the U.S. Treasury yield. I think this is a really magnificent opportunity, and I'm incredibly excited to see what happens in these markets. In terms of areas that I'm interested in, I think I just ran out of time, but I really want to see if this thing is going to continue having this double top and pushing to the downside. Again, with so many speakers coming out and speaking today, there's a real opportunity to see this thing get aggressive and bounce back and forth and back. I wouldn't be surprised if, although we're already building into this position and starting to find some downside pressure, I wouldn't be surprised if the candle for today became something aggressive and we started moving to the upside and breaking this double top. This is a key position, a key area. After today, if we continually find downside pressure, then it could be a great swing trade to the downside, trying to get level to level, trailing your stop all the way down. That is bonds.
Bonds is something that if I understand something the least in these markets, I think bonds is one of those things that I understand the absolute least. But the other thing is you talk about beige book and stuff like that, when they have these bond auctions, bond traders really pay attention to that. And I don't know, like every time I've ever watched like something like a CNBC and that bond trader comes on, he's like my favorite. As far as presenter, he was like my favorite guy on there. He's always so excited about what the bond yields are doing and the results of the bond auction. I'm like, I don't know what you're saying, but I appreciate you. I certainly appreciate you. But yeah, always fun to learn about, as Aaron puts it, like assets that aren't necessarily as sexy, but all these things kind of rely on each other. These markets are connected in ways, when we talk about what stocks are doing, it's because, okay, well, what's the dollar doing? And then what's the dollar doing against another currency? And then you get into Forex pairs. See, so we can all be friends in these markets. The next topic du jour, if you will, is going to be something that, again, we talk about, like, what's the market narrative and what do I feel the market narrative is right now? And to me, the market narrative is, okay, AI infrastructure being built out. What is AI ultimately going to be, in terms of in the short term, right? Is it going to be this human replacement AI that everybody's freaking out about? Or is it going to be something that allows humans to increase their production? And then what companies are going to participate in that and what companies are going to kind of fall by the wayside? So it's really the tale of two markets right now. I feel like more so now than ever, we talk about higher interest rates for longer. Me personally, I think that's a great idea. I think we need to stabilize these markets a little bit and to kind of squeeze them out, because if you got a lot of money and you reduce interest rates, we're going to go back to doing all this crazy stuff we did during the pandemic, buying up everything. And then we're going to have a real housing crisis, and we're going to continue to see food prices escalate, because companies are not going to sit on the sidelines and drop prices out of the goodness of their heart. They have too many investors like us and shareholders to answer to. And so they're going to try and squeeze more money out. So I think that the Fed is doing the right thing by holding off on any interest rate cuts. And if we don't get any different information, we probably don't see a cut. A company that probably does not benefit from higher interest rates for longer is Restoration Hardware. And why do I talk about a company like Restoration Hardware? Well, you can see on the right side of the chart. We'll talk about it here in a second. But Restoration Hardware, for those that don't know, is a luxury furniture brand here in the States. Again, I don't know if they do things overseas or not, but I know that they're very expensive, and my partner loves that place. And I'm like, oh, okay. She has one of her most prized possessions is a custom leather sofa that she bought about 15 years ago from Restoration Hardware, and it was, she went out, custom ordered this thing, and she is very proud of this thing. And it's so, to her, it's like an heirloom piece. Like, she's going to keep this thing forever. It's going to get passed on from generation to generation, and then somebody else is going to probably, in 30, 40, 50 years, they'll throw it in their college dorm room, and then it'll end up on the curb somewhere. But until that point, it's going to be around for a while. So Restoration Hardware, let's talk about it in terms of the chart here real quick, and we'll go through this. So you look at it here, it gapped down on earnings, and we'll talk about the earnings here, not in great detail because this is a kind of a broader scope on it, but it did have a pretty big miss on earnings and gap down from that earnings, and we're sitting down here like on the lows, just off of the October lows. And if you hear anything about the October lows, most of the market ran up from the October lows, including something like a Restoration Hardware. It did run up from the October lows. We did kind of top off here in March, and then we've kind of fallen off and then gap down. And we are again, we did have a green day yesterday, but I think that there's a little bit more pain this quarter to come for a Restoration Hardware. I do not believe that a gap down, move down, and a hold is necessarily what's going to happen, because if you have a fund that has Restoration Hardware, they have to have meetings, they have to have a chat about it, and they're going to go through and say, okay, is this something we need to get offload on our portfolio? So you might see more selling come into this thing in the days and weeks ahead, leading up to the next quarter. And so you're looking at this and you're like, okay, 220 is probably, anywhere between 215 and 220 is kind of like an area of support down here from this swing low in the October. If we give that up, well, that's a double bottom. And now you're talking, levels that we haven't seen since 2019 into the pandemic. So the stock price on a Restoration Hardware is in a really dangerous spot. You look at where it's come from. Look how high we were in 2021. We were, you're talking, $700, and so we've kind of fallen off of that. Had this basis of consolidation, attempted to kind of rally price off of this level here, but you look at the 50 and the 200 just kind of smashed together. Nothing about the price action in this tells me I want to be in this stock. I'm just looking at this and saying, okay, now we've gapped down, and we are continuing to suffer in this thing. So, needless to say, I don't like it on the chart. So again, what am I looking at here? It's a luxury brand in a high interest rate environment. All right, and now if you want to talk about historical versus recently, it's a high interest rate environment. It's higher than what a lot of us are used to. And so we're having to factor these higher costs into higher interest rates. How are you going to pay for this furniture? Right. Are you going to pay it off 6 months, same as cash? Well, if everybody's doing kind of the same thing, like where are you getting, like, am I going to buy a luxury couch when I have to do XYZ, or am I going to trade down a little bit and look at that? And that's what we saw off the last earnings is kind of like we're starting to see like trading down. Prices, the stock price is down 20% on the year. Again, we've given up everything. We're sitting off the October, we're sitting on the October lows. So now we've given up all of the gains that we had from this year, and we're sitting on the October lows. And so I look at that and I'm like, I don't like the idea of that. Cautious. And then the earnings guidance. We talk about guidance all the time off of earnings. Management here recently provided cautious guidance, anticipating continued challenges until the housing market recovers and interest rates stabilize. Number one, interest rates have been the same for a long time. It's not unstable. We've had the same interest rate for a hot minute. The company expects earnings per share to range between $6.91 to $12.62. That's a huge range. Most analysts estimates are kind of like right in the middle, about $10 a share. Not $9.85 is what they're showing. Analyst sentiment on RH is mixed as well. Managed to pull 14 ratings. 5 of them have a buy, 8 of them have a hold, and 1 has a sell rating. So a consensus hold rating. So basically, if you're in position, I guess you got to bag hold this thing. But how long have you been in position? I just showed you on the chart. If you got in a position at the beginning of the year, you're down 20%. If you got in a position off the October lows, you're right around break even. This thing has done nothing for you, and you could have had this bad boy in a savings account and made more money. Why? Because RH doesn't even pay a dividend. It doesn't even pay a dividend. So you didn't even get a dividend payout for the past couple quarters that you've held this thing. So you've held this thing for as long as you had. You didn't get a dividend payout, and now you're sitting at break even. Now, in these markets, be glad that you're break even. Sure. Happens all the time. I could be a break-even trader. I don't like it, but I'd rather be a break-even trader than a losing trader. But still, that's not why you hold something over 9 months to break even. I'm not giving Restoration Hardware free money to go make expensive couches. And that's basically what's happened is they've gotten interest-free, loan from the shareholder. So yeah, you look at that and you're like, okay, the performance that we've seen there, not necessarily where I would want it to be. And then the PE ratio. Let's talk about this thing. Again, you don't pay a dividend. We're expecting this thing to grow or continue to grow. And a PE ratio of 63.6%. in a non-AI industry, furniture, high ticket items. So investors are still expecting this thing to really, really grow. The company, according to a couple of places that I look at, Market Beat being one of them, they're projecting to experience substantial earnings growth with EPS expected to increase to double from what it currently is at 884 to 1534 in the next 12 months. They can say what they want. I don't see it. I really, really don't. Again, they are looking to, expand, build out and have new store openings, but a luxury brand in this environment. And what I mean by that is, yes, we have a market that's at all-time highs. We have, companies with money, people with money, continuing to go out there and kind of spend, but are they spending on luxury furniture if they're not buying another home, right? I think everybody's, we're all homed out. Everybody went and got their real estate licenses, and everybody would try to be in the real estate, and so housing's really tight. It really is. And those that have it are keeping it. They're not looking to necessarily divest from it. And it's, you're not out there buying a home because you want to. You're probably buying a home because you have to. And if you're spending more on your house, right, then you're probably not spending as much on the furniture that's going inside, at least not right away. You have to wait for these prices to kind of come down. So this is kind of like the Old West showdown, like who's going to drop prices first? Is it the home builders? Is it the furniture place? Is it these restaurants? Like, who's going to start this price war?
Who's going to blink?
We've seen, who's going to blink, right? Like, Restoration Hardware, the stuff looks great. I've been on their website. It looks fantastic. I'm like, oh, that's really nice furniture. But you're talking about a couch for like $3,000, $5,000. The cheapo one's about $2,000. Now, you could pay an extra $200 and become a member. And if you're a member, and this is an annual membership, then you get extra discounts on their sale. That doesn't speak to me, like, personally, but there's people out there that they want to be a member of a furniture store, and you can kind of look at that, and say, like, sure. But at the end of the day, they're still expecting sales growth of 3 to 4% for the next for their second quarter of 24. They're sticking with the 8 to 10% sales growth, full year sales growth year over year. Whether they hit that or not, I mean, even if they hit that 8 to 10% sales growth, I just don't like the idea of a non-dividend paying stock in a not necessarily attractive area of the market. Again, this has nothing to do with AI. It's quite the contrary. I mean, unless they're using AI to help build their furniture, which they probably are, but it's not going to be anything where, like, it's not the story of the market in a non-dividend paying stock, regardless of the design factor and everything else. I just don't see myself coming in here and scooping this thing up. It's not on my shopping list. It's not anywhere. It's only in my conscience because I just saw it out there and I'm like, okay, let me look into this and see if there's even, of the two, I like this one the least. And I like Celsius a little bit more because I talked about the numbers there and they kind of made sense if you're being hopeful on the stock. RH, I'm not necessarily very hopeful on this, not buying it.
Amen. I don't blame you at all. When you look at luxury brands right now, some are performing well. You have like a Louis Vuitton, who is, I mean, there's a reason why the owner of Louis Vuitton is constantly fighting for the richest man in the world through a number of really strategic, really wise acquisitions. He's been able to build this conglomerate of brands. But let's face it, when you're buying a luxury product, part of the reason why you buy a luxury product is so you can flaunt it. You buy a Mercedes because you like the badge and you want to see the girls. You want the girls to see you pulling up in the Mercedes. You buy the Louis bag not because you think it's a really nice quality bag and you think that this thing's going to be lasting for 30 years. That's what you say. But what you really think is, it's going to be really cool when my friends see me with this Louis bag. Restoration Hardware, when we're looking at furniture in particular, it's very hard for you to have much status in relation to that. So it's natural, in my opinion, that those kinds of luxury brands, those kind of luxury products begin to fall away as other luxury products begin to step more so into the forefront. Because in the social media world, flexing that you have.
Yeah,
really
unless you're
cool
on like
couch.
Real Housewives of insert city name here, and your house is featured on national TV,
HGTV.
you know,
Yeah.
you know, you're not looking at that. So in terms of like, you know, that recognition and that social validation, it's not necessarily there. Now, if they come out with like, you know how they got the Louis Vuitton like pattern on the purse, like if they come out with like a RH pattern on the couch, and it's like a ubiquitous thing with them, I could see something like that happening. But like at the end of the day, like you know, that's a high ticket item to sit there and say, if I have to build a house or buy a house, am I spending, you know, $30,000-$40,000 furnishing my living room? Probably not. Like, you know, and maybe not. And that's, you know, when I look at like, okay, do I want to swing trade a position or something like that? Is this something that I'm going to use? And I go back to that, and I'm like, no. You know, like I don't go to Restoration Hardware on a monthly basis to go check these things out. I don't like the idea of even walking in there in the first place, because I mean, my wallet starts crying as soon as I walk in there. I'm like, oh yeah, I don't need to be in here. Like, and we talk about like, if you go in there and spend $40,000 on furniture, or even $10,000 on furniture, all of a sudden your time freedom goes from like, hey, yeah, I got some time to do things, to no, I got to go to work because I got to pay for this doggone furniture. So now you bought yourself something you can't necessarily enjoy. And I say that in jest, but you know, I just look at these things and you say, okay, are people going to go out there and splurge on something like this over something else? And probably not. Probably not. And I think that investors are looking at this and they're starting to say, okay, where's the money going to be going to right now? It's not necessarily going to be in furniture or luxury brands. You know, we're going to have to see some price cutting over the next 12 months. And that's where I think at you know, once we start getting into the lowering of interest rates, because we have to lower interest rates and price cutting and everything else, you start going to there. But the luxury brand is not going to be where I go to first. I'll be looking at the Dollar Generals of the world before I look at the Restoration Hardwares of the world.
You better believe it. And speaking of Dollar Generals, I'll be talking about one of their competitors in the next piece of the puzzle. I feel like every week we have to bring everything back to the Midwest. Both David and I have spent a lot of years of our lives in the Midwest. So it's only right that I talk about a company that was headquartered in the city that I spent 5 years in, just moved away from, in Cincinnati. I'm talking about Kroger. Kroger right now is in a massive, a really good position from a lot of different perspectives. Looking at their earnings, they make money. Their financial statements, their balance sheet, everything looks healthy. Looks like they're bouncing off of this beautiful area here. This is a gap fill that just happened, a gap fill play. So there's a lot of reasons why this thing is really exciting. And yet I'm not buying it. Here's why. I feel like, one, when I looked at the chart, when I was doing the research for this particular segment of not buying it, I had this weird feeling, this weird kind of tingle in the back of my head about this equity. What is it about Kroger that I don't like? I shopped there, spent thousands of dollars there. Almost all my groceries came from Kroger when I was in the Midwest. Now that I'm on the East Coast, it's no longer available. Looking at the candlesticks, the delta is incredibly positive. Pre-market, we're trading well above the close, the $51 close from the previous day. So what is it about it that makes me feel weird? There are a couple of things. One, we're seeing earnings in a couple of days. Although we've performed well relative to earnings, we've done quite nicely in terms of our surprises on revenue, on earnings per share. There's a number of different things that we've done incredibly well on. I still feel like the Kroger has an opportunity to fail and has an opportunity to fail well. Let me explain a little bit more. Let me break things down. So when we're looking at Kroger, competitive pressures prompt what's called a no moat rating. No moat rating. A moat rating is something that's used by Morningstar, by Barron's, by Jefferies, by a lot of very large analyst companies, we can call them, that apply values to different equities. A moat is just like you would imagine on a castle. It is a large amount of water, a large pit with ideally alligators inside of it that stop armies from coming in and taking the castle. A company that has a very strong moat around it is a company that's very special. Something like an Apple, a lot of very good intellectual property. Walmart, no one gets deals like Walmart when it comes to their supplier relationships. These are aspects of companies that provide a moat. When Kroger is standing next to the Walmarts and the Costcos of the world, comparatively, they don't really have a moat around them. Although they have 2,700 stores, although they have over 20 supermarket banners, although they're definitely one of the largest brands in the country in regards to groceries, there's a lot about their company that makes me a little bit nervous. One of those things being they produce an incredible amount of their non-perishable and fresh food sales, about 75% of their revenue from their private label portfolio, of which they manufacture. So they depend on people to come through the doors and buy those products in order to make sure that they're able to keep profit margins high. If less people continually walking through those doors because they're more loyal to a Costco, because they're more loyal to a Walmart, then they're losing considerable amounts of their value. The next piece of the puzzle, looking at their actual earnings, as I said before, the cash flow, obviously, the equity's been around since 1968. That's just when they were public. The company was founded in 1884. They're probably not going away for a long time. But giants trip and fall just like normal sized people do. When we look at their performance from a quarterly perspective, we find that there were a couple of times where they didn't have a positive cash flow. Back in the third quarter of 2023, we actually saw a free cash flow of negative $449 million. And this is the first time that we've seen that out of a Kroger in a considerable amount of time. It's been years since we've seen a negative free cash flow in something like a Kroger, specifically in Kroger's financials. So that started to be a little bit of a nerve-wracking thing. When we look at the performance of the equity, when we're just talking about their numbers, they have found some strength, but things have begun to level out more and more and more. We just a couple of years ago, forgive me, their free cash flow was much higher than what it was in 2023 and 2024. We're starting to find that they're recovering, but it's a slow recovery relative to their competitors. When we're looking at different aspects of the equity, this is from simplywallstreet.com, a company actually based out of Sydney. They do incredible breakdowns on equities. You ever get the chance, please use their site. It's really impressive. It shows a couple different things that make me a little nervous about their future growth. And it's one of the reasons why I struggle to add it to my long-term portfolio. Again, when I opened this thing up, when I started doing research, I was really excited because when you look at things like Warren Buffett, Berkshire Hathaway, 7% of their portfolio is in Kroger, but they've been in the doggone thing for 20 years. So their cost basis is very different than yours and ours would be. They look at these 6 different criteria to forecast the future growth of a given equity in order to show how they feel about that particular equity. A couple different things. One, earnings and revenue growth forecast. Again, like I said before, it started to stabilize a little bit. The amount of growth that we're seeing from Kroger isn't fantastic relative to their competitors. When we're looking at analyst future growth forecasts of the company versus the market's expected to grow much more than the company in and of itself. Other consumer retailing companies are expected to grow just a hair faster than Kroger. That's not the concern. The concern is how fast the market is expected to grow relative to the company in terms of annual earnings growth. Their earnings rate versus their savings rate is pretty impressive. Their earnings have grown just about 9% this year. It's above the savings rate of 2.4%. Unfortunately, they're forecast again to grow slower than the rest of the market. Their earnings are forecasted to grow, but it's starting to become a little stagnant. It's not significant. Their revenue is forecast to go sort of slower than the rest of the U.S. market, and their profit margins are expected to do the same. Now, I'll be honest with you guys, there's so much that's really positive about this particular equity. There are a lot of things that give it an incredible amount of value in comparison to a Dollar Tree, a Walgreens, a Chef's Warehouse. This is definitely a better buy. But when you're looking at all the performance checks that you want to see, look at their past earnings performance. We've seen things begin to level out in a way that's just not very exciting. Like I said before, they had a one-off loss, that loss totaling $1.7 billion in his last 12 months of financial results. And it's just not, it's not exciting. This does say that their current profit margin has fallen from last year, but that doesn't really give you the full picture. Their current profit margin has fallen every year for the past 3 years, whereas Walmart's, the Costco's, they've continually gone up. All of these things are negative pieces of the puzzle, and they've made me a little nervous about the equity. Now, of course, they have earnings in a couple of days. On Thursday, maybe their earnings are fantastic. Maybe the weakness in Kroger is going to be solved by this incredible earnings report. Maybe they're able to pop up and say, we've raised our earnings per share. We've done a great job of really capturing that profit margin that we were after, getting above 1.5, which they've been struggling to get above for the past 5 years. Maybe I'm wrong, and maybe we start to see those numbers come to fruition. But again, even if they do, look at the competition. It's fierce. Costco, Walmart, Albertsons. When you look at the amount of money in these markets, a Costco has a valuation of almost $400 billion versus Kroger's 40. Walmart's worth $540 billion in terms of their valuation. I don't care about things like Twitter followers, although they're not doing half bad. They're not doing that bad. They have almost triple the amount of Twitter followers that Costco has. But their revenue and the amount of net income that they're able to produce, it's fractions of what their competition is able to do. And when you look at it dollar for dollar, Walmart's able to make more money dollar for dollar. Costco's able to make more money dollar for dollar. And Costco's able to do that with considerably less stores than, say, a Kroger. All of these things make me a little bit nervous. I really do want to support the company. They're homegrown for me. They were in Cincinnati. I was in Cincinnati for years. I used to drive by their headquarters to visit friends all the time. They've increased the amount of employees that they have on their books. All of these things are incredibly positive, but the reality of it is the technicals are good. I wouldn't mind swing trading this thing, but from a long-term perspective, for a long-term trade, I can't tell you that I'll be buying it. I'll be swing trading it for my long-term investment portfolio. I'm not buying it. Hurts me to say.
Well, a couple things I took away from that. Number one, I love Cincinnati as well. So, Cincinnati is one of those towns that I love to go. They have this grocery store down, Jungle Gyms. They've got 2 locations in the Cincinnati area. And if you've ever been to oh my God, I love Jungle Gyms. Only grocery store I've ever been to with a full-on bar in it. And you can go get you an IPA. And get your groceries on. That place is amazing. So first and foremost, I do like those places. Grocery stores are one of those regional businesses here in the U.S., right? So every grocery store kind of has like its in terms of its competition. But not only is Kroger competing against some of the Walmarts of the world, which are an absolute monster in terms of their pricing power. It's when we look at trying to save on cost and bulk purchasing non-perishables, you talk about a Costco, you talk about a Sam's Club. Those are real threats to a business like a Kroger. And then you still have like the discount stores in there as well. Again, you can shop at Aldi for a little bit cheaper than you could shop at a a Kroger, and they're competing in the same region. I pulled up a Business Insider map as you were kind of talking through this, and I'm looking because I know this to be a regional business. Albertsons typically west, Kroger's typically east, but they're competing with the Save-A-Lots, and the Food Lions, the Piggly Wigglies, what have you. They're competing with all these companies for your business, and it could be very, very trying. I moved to the Midwest. I was a Kroger shopper, and then now I go to where do I go to now? ShopRite. That's the grocery store around here, and it's just what it is. I think they kind of have a handshake deal in terms of the regions, but yeah. Very interesting stuff. So we talked about bonds. We talked about furniture. We've talked about energy drinks. So at the end of the day, we thank you. We thank you in terms of joining us here today. We started off with I still call it J&J. I'm just going to call it J&J. That's just what I'll call it. But J&J in the morning, and then all the way through the London trading floor, we saw those guys kind of raking those profits this morning on the London trading floor, and we'll getting you ready with some trade ideas, maybe some stuff we're looking at, maybe some stuff we're not looking at. But we're going to be back with you on Thursday for Not Buying It, and tomorrow 8:30 British Standard Time, J&J is going to be back with you guys, taking you through the trading day and into the London trading floor. Aaron, see us off.
Yeah, absolutely. That's just real quick. That's a great question. How we go about our research. We're actually planning on doing kind of a special segment on that, talking a little bit about how we get into our research. That's a fantastic question to us. If you guys are curious, I can do a little bit of a breakdown in the Discord, and we'll do a little bit of a continuation of real video on that at some point. We want to really be able to break down. There's so many points and really not enough time. But as always, thank you guys so much for joining us here at TradeDelicious. It has been a pleasure to present things to you, especially things near and dear to our heart from the Midwest. As always, for the rest of the day, for the rest of the week, for the rest of the year, please trade well and trade delicious. Always wear a stop loss, especially on a day like today. For the rest of the day, please trade well, trade delicious. We'll see you next time.